Welcome back to the European Market Open. A minute to go until the start of cash equities trading. Here are your headlines. The Fed warns of stretched valuations amid rising risk appetite. A good time for the Dow to hit another record. Attention turns to today's jobs report. Germany's Chancellor pushes back on a vaccine patent waiver, setting up a potential clash with the Biden administration. Plus, Credit Agricole's profit jumps on low loan loss provisions and a strong trading performance. The lender's CFO tells us it sees a lower cost of risk this year. Let's take a look at what we're seeing on futures then. We've just got 15 or so seconds to go until the start of the European equity trading session, and futures are pointing to the upside. A little bit of catch-up trade perhaps coming through here because US futures are a little bit more muted in the gains that they are anticipating. But here, from a European perspective, we've had a host of earnings. We'll look out for movement in IAG after that airline put forward its numbers, although we get a press conference later on today, which might be more important there. We've also had numbers from a host of German companies, upgrades to performance expectations from Siemens and also from Adidas. So we'll certainly focus on those German names as we see the Xetra DAX open. So for the moment, we have the FTSE 100 open and it's up by around 0.25%. The IBEX over in Spain up by 0.7%. So we'll be looking for the Xetra DAX to see how that is going to open. As I say, plenty of German names reporting this morning. We also had numbers out of BMW as the third of the three, the third of the trinity that I was thinking of. We have the CAC 40 opening to the upside. That is up by 0.5%. So a fairly risk-on picture coming through. It is non-farm payrolls day, though, and it is a day where typically we wait and see how that payrolls number performs before perhaps closing positions ahead of the weekend. But just still waiting for the Xetra DAX. But as I say, we are moving to the upside broadly across these European equity markets, up by 0.6%. So European equity markets opening stronger. The Federal Reserve has warned over asset prices in its semi-annual financial stability report. It says rising risk appetite across a variety of asset markets is stretching valuations and creating vulnerabilities. Joining us now is Jordan Rochester, Nomura FX strategist. Now, Jordan, good to speak to you. We heard from the Fed then they weren't talking specifically about bubbles, or at least they don't use that word, but they are concerned about stretched valuations on certain asset classes. They mention meme stocks, and there is a passing reference to crypto, but there is a reference certainly to meme stocks and to the sort of frenzy around that. In the FX world, do you just sit and watch these bubbles, if they are bubbles, emerging elsewhere? Or do you think concerns around financial stability, do they find a home in FX markets at this point as well?
They don't right now, Anna. I don't have any trades on where there's a financial stability risk driving that trade, but they do matter. So remember when GameStop really accelerated that sort of meme stock trade, and then we had a pullback, and it led to some risk appetite dropping in the major markets. It was very temporary, and you'd have to really follow it on an hour-by-hour basis to see it. You couldn't look now on the chart and say, yep, that's definitely GameStop by looking at S&P 500. But there was some issues for our markets when we had those sort of risk appetite highs and lows. It is important if this leads to some sort of credit bubble popping, if we were to see something like an exchange collapse or something like that. It's all about risk appetite in that scenario. So the feed through from meme stocks, Bitcoin to the dollar, for example, and euro dollar and FX trades is actually quite low right now, apart from that correlation to risk sentiment.
I wonder where you think we're going to go on the US economic story as told to us by the jobs creating machine, Jordan. We're thinking about jobs, of course, because it's non-farm payrolls day. And I wonder what is in store for the dollar on various outcomes. I'm thinking about this because I was reading a piece by one of my colleagues that said last time we saw a weak jobs report, the dollar dropped. But you could also argue that if we get a strong report, that's risk on, and that could also lead to a dollar drop. So is it all downwards for the dollar regardless of what we get, or do you have a different view?
I have a different view to that, which is the data really does matter. And the view that you just read out from somebody else there just said, ignore it, essentially, the dollar will weaken. No, it's important because data surprises matter. The charts that we follow, if the US data does better than the euro, the dollar strengthens. There's no doubt about that. We had that in Q1, essentially. What I argue is that in the first quarter, the EU's slow vaccine rollout has really weighed on economists' expectations, lowering their views on growth this year. The US, the other way around, the Georgia Senate results led to a massive upgrade in US growth forecasts, which means the bar is higher to surprise. What does that mean for today's non-farm payrolls? It means even if you get 1 million, 1.3 million jobs added, talking with clients, no one's really going to say, oh, I've got to buy me some dollars. So the surprise has to be really big, like 1.5 to 2, which is a bit off the scale and probably unlikely to happen. So, Anna, the person who you read out there is kind of right, where it's not too big of a deal for the dollar right here, right now, if it's around what's expected. But, of course, surprises do matter.
Thank you very much, Jordan. Stay with us. Jordan Rochester, Nomura FX strategist. We will be back to Jordan shortly because I want to get his views on what's going on in the UK. It was a Super Thursday. It's now over and votes are still being counted across the UK. English local elections could offer a verdict on Boris Johnson's leadership. We could also be into a very interesting period with regards to Scottish politics. We'll be back to talk about that shortly. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Technology brings you a special look into the recovery and renewal happening in Boston. Hear conversations from business and political leaders, including Moderna co-founder Noubar Afeyan, Bain Capital co-chairman Steve Paliuca, and Boston interim mayor Kim Janey. Catch the Bloomberg Technology Special on Boston's recovery, Tuesday at 5:30 p.m. on Bloomberg Television.
Welcome back to the European Market Open. We're 7 minutes into our European trading session, seeing some upside for European stocks right now. Now, over to the Bank of England, which is slowing its emergency bond buying, signalling it's on course to end crisis support for the UK economy. Speaking to Bloomberg's Francine Lacqua, Governor Andrew Bailey also said the Bank of England would need to see some kind of negative shock before it would consider expanding QE next year.
We've been clear today, we have not changed the stock of quantitative easing that we're doing this year. So what we've changed is the pace at which we achieve that stock. But actually we haven't changed the end date. We always said we would end it around the end of this year. We front-loaded it somewhat because back in November we were in the midst of an upsurge in COVID. We were concerned about financial markets situation, the performance, and ensuring that financial markets continued to be robustly performing. So it made sense in terms of market efficiency to front load it. We've now got to a point where we think it makes sense to now move back to a flow that meets that eventual target.
And you've made that very clear. Given how the markets initially reacted, what does it tell us about market positioning or market exuberance, or how much focus will be on any signal on tapering?
Well, I fully expected, I can tell you, I fully expected we'd be having discussions like this because, it's reasonable for markets to ask the question. And of course, there is this point about, bringing out the difference between open-ended and fixed QE programs. They are different in that sense.
So what are your expectations for QE next year?
I don't have any expectations at the moment at all. I mean, because the decision we took today was to say that the current policy setting was appropriate.
But what kind of trend are you expecting? If you look at your forecasts, right, they're built on 2 rate hikes over the next 3 years, and that has inflation just at target. Yeah. Is your next move tightening?
Well, we don't, of course, our forecasts don't validate the markets in that sense. We use the market profile to construct a forecast, which is then, used in the policy process. What I would say is that it's quite interesting when we also publish a constant rate forecast conditioned on constant rates, i.e. the current setting of policy. I mean, the difference in inflation terms at the terminal point of the forecast between the market path and the constant path is pretty small, in fact, in inflation terms. So I wouldn't overinterpret the point about the market curve, but just to reemphasize, it's a convenience for us to use the market curve, and I think it's helpful, but it does not determine policy in the sense that it's not mechanical.
Can you give us an indication of how you tighten? So is it rates first or QE?
Well, we're doing the review at the moment, or we will be doing the review. We started it. And the reason for that is that the MPC adopted guidance back in early 2018 on this point and said that they would tighten, or they would increase rates up to level, I think it's 1.5% before they considered reducing the stock of assets. Now, what I would say is that, of course, state the obvious, an awful lot has happened in the intervening period. So the stock of Bank of England quantitative easing has risen substantially, obviously, as a product of COVID. It seems, therefore, appropriate to come back to that question and say, does what's changed in the meantime, cause us to adjust our view?
That was the Bank of England Governor Andrew Bailey on tapering support for the UK economy as it emerges from the pandemic. Now, Prime Minister Boris Johnson's ruling Conservative Party has won an historic by-election victory. It's taken the seat of Hartlepool, that's voted Labour since it was created in 1974. Votes are being counted in other regional races and also in the Scottish parliamentary elections. Jordan Rochester from Nomura is still with us. Jordan, there's a lot to talk about from a monetary policy perspective in the UK and also from a political perspective. I was trying to shoehorn in a question that would allow me to reference the saxophone in the room, which looms so large over your shoulder. And I think I've got it. If you could tell me which currency you like the mood music, there you go, for. And I think that takes us nicely into a conversation around the pound.
Well, okay, I'll give you a careless whisper about it. When it comes to the currencies that we're looking at, which trades we like, we like high beta, which is currencies that do well when you have growth expectations rising. So that is the pound, that is the Canadian dollar, that's the Australian dollar. These currencies stand out because they're exposed to commodity prices, which, as you know, are rising. So Canada's doing pretty well. Australia has this political issue with China at the moment, and that's kind of been holding it back. It also isn't as high carry as it used to, thanks to the RBA's monetary policy setting, where Canada's a bit of a clearer choice because the Bank of Canada is tapering. But to bring it back to Scottish elections, I guess, Anna, is kind of where you were going with that kind of lead in. We spoke about this on Nomura's podcast this morning. It's on the podcast store, and we essentially explained that it's all about the 50-50 mark for me. So the S&P has been polling at 50%. So if it comes in around there, it's not going to move the market. If it comes in at 47%, Boris Johnson will argue that the S&P clearly don't have a mandate to call for an independence referendum. It won't end the debate, but it will definitely soften the impact of the election leading to an independence at some stage. If you get above 50%, 51's not going to move the market too much, but 52, 53, that's when you see sterling lower. And we get the results on Saturday, so we're going to be dealing with this on Monday morning. But the view I give to my clients is the S&P doesn't actually want a referendum anytime soon. They say the end of 2023. Time is on their side. Demographics, the younger voters support independence much more than the elderly. It just makes more sense for them to delay it. So
you're long,
we get
a
a 53%, let's
Jordan.
say, for the S&P.
Right. Yes. So that could change things. So when you talk about being long the pound, that is not because you don't think that Scottish independence will happen or any assessment of whether Number 10 will grant them a vote or not. It's just that whatever happens, it'll take a long time to get there.
Yeah, we talk about these macro events, the politics, and what the latest central bank speak is. But Anna, for me, it's all about the flows. We track the flows in FX. That's how we make these medium-term trades work. The UK really stands out because this reopening trade away from Peloton and technology companies into what got really hurt last year, which is commodities, financials, staples. The UK equity market, Anna, has had 10 months of inflows on the ETFs we track by foreign investors, and it accelerated in April. So those flows, Anna, make most of this political noise irrelevant to me for my sterling trades. It's interesting. It's a nice conversation to have. And if it gets me to the point where I can talk about how great these flows are, happy to do so.
Okay, let me go to another conversation, Jordan, which I hope you approve of. We're going to talk about the ECB Council member, Martin Kazaks, who's been speaking to Bloomberg, and we're getting some red headlines crossing the Bloomberg, or one, as a result of that. He's saying that the decision to slow bond buying is possible in June. And I mention this because what was quite lackluster trade in euro dollar suddenly jumped up. We see the euro strengthening just a little on this. We're up just 0.1% or so, but we're at 120.81, so back over that 120 level. And it seems to be a reaction to this. So this is ECB Council member Martin Kazak speaking in a Bloomberg interview, saying that a decision to slow bond buying is possible in June. Would that fit with what you're expecting, or do you see that decision coming later?
That is coming later. It would, but as you're seeing, the market's moving on the back of it. It definitely raises it as a risk. That's another thing we mentioned on the podcast. I asked my colleague Chiara this morning on Nomura's podcast, will the ECB look to taper just like the Fed's talking about doing? In a way,
it does seem we're having some problem with Jordan's.
And the ECB is stuck in the last part of this race.
Jordan's line. I do apologise. I'm just going to jump in there because it seems to be in and out, and we're catching some of what Jordan's saying, but not all, and that is a shame because I wanted to get his response. I did hear a little bit of his. I don't think it's his base case that the bond buying conversation or the decision to slow bond buying it comes in June, but clearly the market is thinking about whether to take this seriously or not, because we see a pop of now around 0.1% to the upside, 120.83 on euro dollar. Thanks very much to Jordan Rochester, if you can still hear me, Nomura Forex strategist, of course. Coming up here on the programme, Siemens gaining this morning after beating estimates and raising its outlook for the year. We hear from Roland Busch, Siemens CEO, next. This is Bloomberg.
concise conversation on Bloomberg Surveillance.
There's no vowels in a digital future.
Come on, John, I just think it works.
It works for inverters.
We've beaten this to death.
Watch weekday mornings on Bloomberg Television.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Welcome back to the European Market Open. Just coming up to 20 minutes into Friday's trading session, and we're making some gains across European equity markets, modest in some cases, strong in others. The Xetra DAX up by 0.9%. We've had a host of earnings and some upgrades to expectations coming through from some German corporates this morning. Let's get a Bloomberg Business Flash. Some of the top corporate stories we're covering today. Laura's got the details. Laura.
Thanks, Anna. Peloton is looking to ease concerns of investors, saying the hit from its treadmill recall will be short-term. It sees the return of the products reducing revenue by around $165 million. Investors had been preparing for a larger hit. Peloton also says it has overcome supply issues that slowed deliveries of its popular stationary bikes. The largest U.S. crypto exchange, Coinbase, sank to a record low yesterday. It left the shares just above the $250 reference price for its direct listing in April. The slide comes as investors are pouring into extremely speculative cryptocurrencies like Dogecoin and Binance Coin, tokens the exchange doesn't offer. Nintendo shares are trading lower after the console maker warned that component shortages could affect production. It's giving a conservative forecast for the year, overshadowing better than expected results for the past quarter. But Nintendo, like many Japanese companies, often sets expectations low, so it has room to upgrade its outlook. That's the Bloomberg Business Flash. Anna.
Laura, thanks very much. Laura Wright here in London. Back to the earnings story then, and Siemens is gaining this morning after raising its net income forecast for the year by 700 million euros. It's the latest sign Europe's biggest engineering firm is benefiting from the global recovery led by China. CEO Roland Busch says that he expects the strong momentum to continue. He spoke earlier to my colleague Matt Miller.
I mean, you named it, automotive. These cars are meanwhile loaded with electronics and they need a lot of demand, have a lot of demand. At the same time, they're fighting, obviously, also for these chips compared to others, the IT companies, so producing laptops and the like. So this is, I think this is the point where you have to look at. But other than that, I think it's really due to the impact which we see from the market that many markets are pulling up now. We see that this can hit anybody who is not a really stable supply chain.
What about input costs? You know, we've seen an increase in prices for so many commodities. Metals specifically have been really eye-popping increases in price. How are input costs affecting Siemens?
That's true. We have a price increase in raw materials as well, but also in the freight costs. And in our short cycle business, we put that into our price. So we have a price increase, slight price increase in order to compensate for it. So therefore, I would say this is contained. And you can see it also from our results. We increased, for example, in DI. We increased our margin now in this quarter to a 20.1%, which is an extraordinary margin, but also the margin of SI going up to above 11%. So therefore, I do believe that we have that quite under control, but again, you have to watch it closely.
What's your take, by the way, on the possibility of opening up IP for those vaccines so that everyone in the world can start to manufacture them? The Biden administration seems be behind that idea, and the Merkel administration seems against it.
I do believe that the most important element is now getting vaccination of people up as fast as possible. This is the only way, and in all countries. And this is and looking to India, I think you can understand that definitely needed. And we are here to help. I mentioned to you the example of BioNTech. We help BioNTech to ramp up their manufacturing extremely fast. and shortened their cycle time, and we can't do that for any other company in the world. So having this learning, what we have had now with BioNTech, and support any manufacturer in the world.
What you have 292,000 employees, at least. That's the latest number that I've seen, Roland. What kind of return to work can Siemens employees expect? Back in the office, hybrid work model? What would you like to see as the new work experience for Siemens employees?
We have a clear strategy, and we announced this strategy already in August last year. We said that wherever it's possible, I mean, for some jobs it's not possible, for example, if you assemble a train, but wherever it's possible, we give our people the opportunity to have 2 to 3 times in the office, 2 to 3 days in the office and 2 to 3 days remote work.
That was the Siemens CEO, Roland Busch, speaking with Matt Miller, tackling a whole host of subjects from the earnings story to the return to office narrative, and also thinking about vaccine rollout, mattering, of course, to any business. Let's take a look at some of the stocks that are on the move this morning. And for that, here's Danny Berger. Danny.
Anna, we got a big pop from Adidas. As soon as it opened, they've upgraded their forecast. Good online sales, strong sales from China. They also see more sales even coming, so they're raising their forecast because of the return of big sporting events, of the European Soccer League, so all of that's helping them. Puma also raising in sympathy, so let me show you that share price. That's up more than 2%. Again, it's a sporting goods story. Investors here bidding it up with Adidas. Credit Agricole, also want to talk about banking, so we're still getting the last remaining bank earnings reporting, and this share price just shows you how fickle shareholders are at this moment. Credit Ag opened higher. They beat on their expectations. They had stronger trading, lower loan loss provisions, but that's not necessarily enough just to beat in this environment. Finally, let me show you the macro picture. NFPs, it's going to be a big day today, but a lot of volatility in predictions, so we're not getting big moves when it comes to U.S. assets. Of course, we have copper hitting an all-time high again, Anna.
Yeah, a lot of focus on commodities. You're right to put that in copper, Danny. Thanks very much to Danny Berger. And we saw just behind Danny there in that picture, we saw futures. And just to mention that U.S. futures have been deteriorating over the last 10 minutes or so. Flat to negative, I guess you say. NASDAQ futures just around that flat line. Coming up, we'll talk about vaccine IP waivers. It's set to pit global leaders and pharma against each other and lead to thorny negotiations at the WTO. We'll get the latest from Sam Fazeli from Bloomberg Intelligence. That's next. This is Bloomberg.
Renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50% 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and death. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open. Half an hour into Friday's session, European equity markets on the front foot, in particular in Germany, up by 0.8%, where we see some strength this morning. If we have a look at the sector picture, you can see where some of that is coming from. Consumer products and services, and the biggest gaining sector, the biggest gaining stock, there is Adidas. That stock up by 6.9% as a result of the earnings upgrade that we got from Adidas this morning. That, as we were hearing from Danny Berger, lifts also Puma, that in the same sector, up by 1.9%. And we don't see many stocks in that sector actually moving to the downside, just 3 out of that whole sector of consumer products. We do have some sectors in the negative space, though. You can see construction materials, real estate, and utilities. So perhaps some more defensive names, certainly in utilities, to the downside, down by 0.4%. Now, let's talk about the pharmaceuticals market. A proposal for vaccine patent waivers is leading to potentially thorny negotiations at the World Trade Organization. That is after the German Chancellor Angela Merkel came out against a proposal to waive intellectual property protection for COVID-19 vaccines. It's in contrast to European Commission President Ursula von der Leyen's stance. Speaking at a virtual conference in Italy, she announced the bloc's backing to discuss, at least to discuss, the plans. That is after the US first said it supported discussion on the waivers. Joining us now is Sam Fazeli, Bloomberg Intelligence Director of Research for EMEA. Sam, good to speak to you. So give us your thoughts. I was relying on some stats provided to me by our colleague Lionel Laurent, talking about how the wealthiest 27 places in the world account for 10.5% of the population, but 35.6% of vaccinations. So certainly suggesting that it is, wealthy countries, and we know this already, that have been benefiting from vaccines, and something needs to be done to spread vaccines more widely. Is changing rules on IP the thing that needs to be done to make that happen?
Good morning, Anna. Unfortunately, the simple answer to that is no, and a very emphatic no. It looks great. People can beat their chest saying, look, we did this for the world. But the reality is that this isn't actually pitting the countries, WTO versus pharma companies. It's going to be pitting countries versus countries. The process will be long-winded. There are, as you have already seen, countries that will oppose it. The reason simple is that it actually makes very little difference. Moderna already, way before this, had said that they will not enforce their patents during the pandemic, which is now. Nothing happened. Nobody rushed to manufacture product. Nobody established manufacturing suites because it's very, very difficult to do.
And if we assume that the Biden administration knows what you've said, knows the line that you've taken there, Sam, and that's been explained, and the EU also has heard these arguments, why do you think that we're hearing this politically? Is this some political grandstanding, or is this designed just to simply hold the pharmaceutical companies' feet to the fire, if you like, and just try and add some pressure to get things moving more quickly?
Well, how much more quickly can they go? Moderna started the year thinking they're going to be able to do 500 million doses. They've already raised that to 1 billion this year. Pfizer-BioNTech was going to do $1.5 billion. They raised it to $2.5 to $3 billion. You can't make vaccines out of thin air. You need the product, the materials that go into it, and you need to do it at a pace that doesn't compromise quality and safety. These are critical elements. I think people forget this is not making a recipe. Of course, you haven't suggested that in your kitchen or a simple generic product. This simple idea of sterile fill and finish is extremely difficult. Pfizer had several years of problems with that, with their Hospira business. These are very complex processes, and I think it's nice to wear a halo for a few days as a politician who says, yes, we're for this, but I doubt this will make any difference, certainly not for another 12 months.
Is one of the issues, I mean, we heard similar arguments coming through. We spoke to Natalie Moll from the EFPIA, the European Federation of Pharmaceutical Industries and Associations. And of course, she was not in favour of this change to IP protections. And she made some of the same arguments that you make, Sam, which all sounds, very sensible, and we take those on board. But she also says that the waiver would remove incentives for companies to continue research into new variants. And I suppose it's the lining up of incentives during a pandemic that maybe leaves some people feeling a little bit queasy. I mean, how are these firms incentivized at this point to enter this battle?
Well, two of them, Johnson & Johnson and AstraZeneca, are incentivized by helping humanity. They are not making money. AstraZeneca lost money in the first quarter. Can I say that again? AstraZeneca lost money in the first quarter on their COVID-19 vaccine effort. So we can't just brush them all with the same brush. And at the end of the day, the fact that a pharma company who created the best or two of the best vaccines so far in terms of efficacy and safety, Moderna and Pfizer-BioNTech, are being beaten up for potentially making $20 billion or $25 billion, some of which they'll reinvest in the development of drugs for the rest of the world, etc., is a bit sad as far as I'm concerned, given the amount of risk they took, because these things could have not worked. And who would have borne the cost of that? Pfizer and BioNTech didn't take any U.S. government money. So I think we have to be very careful. And frankly, we're in a good position not to have any sides here. We're not an industry body or care whether a pharma company's shares go up or down. The reality is we have to just be real with this.
Yeah, there's an interesting point about government money. I mean, there was some government money, of course, has gone into some of these developments, but great to get your thoughts. Always good to speak to you, Sam. Thank you very much. Sam Fazeli, Bloomberg Intelligence Director of Research for EMEA. Let's get a Bloomberg First Word News update. Here's Laura Wright.
Thanks, Anna. Japan is set to extend its state of emergency to the end of May. The measures cover Tokyo and some other major cities and are being expanded to include 2 more regions hit by rising case numbers. They'll now include about 40% of the country's population. It comes less than 3 months before Tokyo is set to host the Olympics. Bloomberg sources tell us the UK plans to offer under 40s an alternative to the AstraZeneca vaccine. That's due to concerns about blood clots that affect a tiny proportion of those receiving the shots. The decision could be announced today and comes as officials prepare to open vaccinations up to those under 40. Wall Street's new overseer has laid out his agenda for increased regulation in a number of areas. Securities and Exchange Commission boss Gary Gensler made his first appearance before Congress since being sworn in. He pledged to look into the wild price swings of the GameStop saga, cryptocurrencies, and the derivatives that triggered the Archegos blow-up. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thanks very much. Laura Wright here in London. Now, China's securities regulator is weighing tighter rules for companies seeking to list in Hong Kong or overseas. That is according to Bloomberg sources. The move could hit technology firms already hampered from months of clampdowns in various forms. Let's speak to Bloomberg Executive Editor for Greater China, John Liu. John, really nice to speak to you then on the European market open. So what do we know so far about what China is planning here?
So the securities regulator is considering a number of proposals that would tighten rules for Chinese companies seeking listings outside of China, in Hong Kong and New York and other places. Among the things they're reviewing is asking these companies before they make filings in New York or in Hong Kong to submit those documents to Chinese regulators. So the regulators want to check that whatever is in those documents they are in accordance with Chinese laws and regulations. And also they want to check that there is no information that's sensitive relative to national security that might be released.
And what happens now then, John? Where does this go from here?
Well, we have a number of big Chinese tech companies waiting to list, in the wings, waiting to list. You have ByteDance, obviously the owner of TikTok. You have Didi, Kuaishou, the ride-hailing company. If these new regulations come into place, obviously that would probably elongate the process of those listings coming to market. It's unclear whether they would derail anything. I think Beijing has full intention of wanting these companies to do well, to excel, to become innovative national champions.
And these tighter rules then, when it comes to these rules, if they come in, what kind of effects might that have? We've already seen some of the technology names moving on this, and is this going to be something that makes technology names just list at home?
Well, so the tech sector has been the area where the most companies from China have gone and listed in New York and Hong Kong and other places, and so obviously it's hard to see this happening now without thinking about the larger crackdown that Beijing's been executing against big tech. I think the greater scrutiny of Ant, of Alibaba, of Tencent recently, all that speaks to Beijing having a greater suspicion about what these tech companies are doing, and Beijing wanting a bigger role, a bigger hand in how things play out.
John, thanks very much for the update. Bloomberg Executive Editor for Greater China, John Yu, bringing us the latest developments on that story. Coming up here on the European Market Open, and that's a wrap. We look at the winners and losers as this earnings season, draws to a close. The first quarter review is up next. This is Bloomberg.
This is basically going to kick off the whole week.
From bank earnings really have to be front and center, to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
We're also seeing a really strong recovery.
No one delivers the data faster.
Nestle's out with numbers. Can this company continue at this kind of clip?
Bloomberg Television, your home for earnings season.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Welcome back to the European Market Open. We're 43 minutes into our trading session and European equity markets are seeing some upside. US futures are fairly flat. They've been either side of the flat line basically over the last half an hour or so. We do have some strong gains coming through from Germany. Where we had some corporate reporting that resulted in a surge in the share price for example, Adidas on the back of their numbers. Now, sticking with the stocks theme, with the European results season mostly done, let's take a look at the winners and losers from this quarter and the big themes that dominate the markets. Joining us now with an earnings wrap is Tim Craighead, Senior European Strategist at Bloomberg Intelligence. Tim, good morning once again. So what is the current scorecard for the first quarter, for the results that we've seen? Where do we stand on the beats versus misses?
Well, it's been a pretty unambiguous beat for Q1 in summary, Anna. About 3/4 of the market cap has now reported, and with that, roughly half have beat on the top line, and 2/3 or so have beat on the bottom line. And the big theme that we take out of this is operating leverage. We've had roughly flat-ish sales as a result in Q1, but we've had 50% earnings growth. And the 50% it compares against an expectation coming into the first quarter of only 25%, only. But, the point is, huge surprise, and cyclicals with that are leading the charge. Part of this is the low base given last year's comparison. Part is that business is coming back to life, even though there are still restrictions in Europe and around the globe, and in parts the reflation story.
And how do you think that the focus on chip shortages, supply chain management, how is that rippling through this earnings story? We've spoken to a lot of corporate executives who quote higher raw material costs or supply chain issues.
Yeah, it is a big deal. As constructive as we are with what we're seeing, this is the big risk factor. And, I guess all in all, I'd rather be worried about this in advance than being blindsided after the fact. And it's good that it's bubbling up and everybody is giving it due consideration. We've seen comments coming out of management calls where this is now being addressed proactively. As opposed to last quarter where it was something that some analysts were asking managements. But in total, we do think that you've got an issue of sales coming through, but if you ended up being short-circuited because of supply constraints, that's not good. Or margins, as I mentioned, that should be improving, but if that's derailed because rising costs, that's not good. So those are the concerns. If you take the whole thing, though, and look past just the concern, guidance has actually been pretty positive. More than 50% of the companies are actually guiding up. The 25% or so that have lowered forward guidance, A, is a minority, a big minority, and B, to your point, it is a concern. Those are the stocks that have taken a hit relative to the market.
Yeah, certainly the theme of this morning has been guidance upgrades and not downgrades, and we're certainly seeing some companies rewarded for that. Let me ask you about tax plans in the US. President Biden with his tax hike proposals. Tim, you've been giving some thought as to how that impacts on global businesses. What's your thinking?
Yeah, it's another big risk factor to the market, is sitting here at highs. Beyond the supply chain issue, we've got the U.S., a lot of exposure from a European perspective, and potentially seeing taxes go from a 21% corporate tax rate to 28%. That's scary. Our analysis, though, takes a little of the sting out. It's early days, and we can't go through the details of all of the tax planning that occurs, but we only see a couple of percentage point impact to earnings, to net income for the stock 600 if we were to see that type of a jump. There's all sorts of offsetting factors. And, interesting enough, if you go back to 2017-18, when we saw the big tax cut, we actually didn't see a big change in European effective tax rates in 2018 either. So, not to make it a lot to do about nothing, taxes are a big deal, but we're a bit more concerned about what's going on from a European tax perspective than we are the U.S. And in the end, over the course of the next year or two, there will be proposals put through because we do have to pay for all this stimulus that's been such a big deal. And frankly, a big part of the reason why we've been so constructive on the underlying fundamental dynamics of the marketplace.
Tim, thanks very much. Thanks for joining us. Tim Craighead joining us there from Bloomberg Intelligence, Senior European Strategist for Bloomberg Intelligence. Thanks very much to Tim. Let's get up to date with some of the corporate stories that are moving the markets in the way Tim describes. Here with the Business Flash, here's Laura.
Thanks, Anna. Peloton is looking to ease the concerns of investors, saying the hit from its treadmill recall will be short-term. It sees the return of the products, reducing revenue by around $165 million. Investors had been preparing for a larger hit. Peloton also says it has overcome supply issues that slowed deliveries of its popular stationary bikes. Nintendo shares are trading lower after the console maker warned that component shortages could affect production. It's giving a conservative forecast for the year, overshadowing better than expected results for the past quarter. But Nintendo, like many Japanese companies, often sets expectations low, so it has room to upgrade its outlook. Some of the City of London's biggest firms are backing government proposals designed to attract more business. One of the ideas would allow dual-class shares on the London Stock Exchange's premium segment. Firms also supported lowering the minimum stake that has to be floated in an IPO. That's the Bloomberg Business Flash. Anna.
Thanks very much to Laura for that. Laura Wright with the Business Flash here in London. Now, every Doge has its day, and this week it could be Saturday when the self-proclaimed Doge father, Elon Musk, hosts Saturday Night Live. Ahead of his appearance on the American comedy show, Dogecoin has staged a massive rally to become the fourth largest cryptocurrency. Any excuse to play these pictures, frankly. Danny Berger joins us with a look at all of this to make sense of all the puns I just read out, and with a view on really, did Saturday Night Live just suddenly become a market-moving event?
Yeah, well, first of all, I used to think that our videos of paint mixing were my favorite thing, but I have now decided that those are way better, the Dogecoin videos. But look, everyone expects Elon Musk to go on Saturday Night Live, make some joke about Dogecoin. Everybody is going to love it. They're all going to go in, buy Dogecoin, send it higher, because of course it trades over the weekend. And this is kind of like the strange world we live in. Here's a tweet Elon Musk sent out when he announced that he was going to be on SNL, the abbreviation of it, on May 8th, calling himself the Doge father. I mean, look, he is so representative of this meme investing culture, tweeting out he's going to take Tesla private at 420 a couple years ago. I mean, it really is this fandom around it that people like, and that's part of the reason why Dogecoin does well, because it's fun. I mean, it's not an insult to say people trade it as a joke, but regardless of its sort of jokey status or not, we have serious analysts making comments about Dogecoin. Here's one from Oanda talking about that his army is probably going to send it to the moon after his SNL appearance.
Yeah, certainly. We'll be looking for all those emojis. Danny, thanks very much. Bloomberg's Danny Berger on what you can expect from your Saturday night, perhaps, if you're interested in cryptos and Dogecoin specifically. Coming up here on the program, we're back to a slightly more serious business of monetary policy. Latvia's central bank governor says the ECB could decide to scale back its emergency bond buying program as early as next month. That briefly caused some reaction in the euro. We'll discuss the market reaction with Bloomberg Market Live's Ven Ram. He's with us next. This is Bloomberg.
trading revenues coming in better than expected, everything. Cash, $1.4 trillion of cash, one of the most notable aspects of this report that was stellar.
Welcome back to the European Market Open. Some 54 minutes into our trading day, making modest gains if you're in Paris, strong gains if you're in Frankfurt here on these European equity markets. Let's talk to Ven Ram, Bloomberg Markets Live currency and rate strategist. And talking of currencies, Ven, we had some interesting excitement just at the top of the hour, didn't we, with regards to the euro? Does that momentum in the euro last? It seems to have faded a little already.
Well, you're absolutely right. It's already given up much of those gains. That's because the market kind of realizes that achieving a consensus at the June meeting is going to be far from a slam dunk. The decision on slowing those purchases is possibly the most difficult decision the ECB will take this year. And there are enough Dows on the board who will warn that removing the monetary accommodation prematurely will have consequences for the economy. On the other hand, the hawks, and Kazakhs is one of them, will be concerned about risks to financial stability. So it's going to be a very challenging decision. And we are bound to see leaks between now and the June 10 decision. And consequently, we're going to get those knee-jerk currency and bond market reactions.
I like very much that the title of one of your pieces this morning, "We Didn't Start the Fire." I'm drawn to the Billy Joel reference. We're only feeding it, and this in reference to the bubbles, if you want to call them that, the Fed is concerned about now in various asset classes. Your thoughts, your reflections, briefly, Ven, on what we heard from the Fed.
Well, I mean, we've heard throughout this week that, from Fed speaker after Fed speaker, that, look, now is not the time to be tapering. We need to be seeing a series of data prints rather than just a one-off data print. And in that context, today's payrolls data is going to be mighty important, I think. And the market expectations are for the number to come in around 1 million. Anything higher will lead to a sell-off in bonds, steepen the curve, and make stocks wobbly.
Yeah, certainly something to watch out for then. We'll be focused on those non-farm payrolls numbers. Thank you very much, Ven, for joining us. Ven Ram, Bloomberg Markets Live currency and rates strategist. That is it for the European Market Open. Surveillance early edition is up next. European equity markets, broadly speaking, making gains today. US stock futures look fairly flat. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry,
buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Every single thing, from the deck of an aircraft carrier to a railing in a new building, is going to be built by an American company.
It's really important to get the vaccine out there as quickly as possible. There's an urgency here, and that's what the waiver is about. It's not changing the basic framework.
We've been clear today, we have not changed the stock of quantitative easing that we're doing this year. So what we've changed is the pace at which we achieve that stop.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning and welcome to Bloomberg Surveillance Early Edition on this Friday, the 7th of May. I'm Francine Lacqua in London, and here's what's coming up on today's program. Rising risk appetite becomes a concern for the U.S. Federal Reserve. The governor, Lael Brainard, says more granular disclosure may be necessary after the Archegos debacle. Bloomberg learns that President Biden is likely to keep up the Trump-era limits on Chinese investments. And Cathie Wood's ARK Innovation ETF slides another 3% as inflation fears take hold of investors. Coinbase plunges to its lowest level since last month's IPO. So the Federal Reserve has warned over asset prices in its semi-annual financial stability report. It says risk appetite, well, for risk across a variety of asset markets, is stretching valuations and creating vulnerabilities. Lael Brainard, who heads the board's Financial Stability Committee, said, quote, the Archegos event illustrates the limited visibility into hedge fund exposures and that as a result, the level of risk may be missed by regulators. Now let's get more on all of this on the Financial Stability Report with our Danny Berger. Danny, what seems to be the consequence, and good morning, what seems to be the consequence of the Fed actually bringing this warning over asset prices?
Yeah, it's really interesting talking about Archegos and, again, sort of the froth in the market. And look, I think that market participants were already very surprised at the end of last month when Powell talked about there being signs of froth in the market. And so they'll probably be even more surprised to read the stability report and see them talk about meme stocks. Francine, as far as I'm aware, we've never had the Fed saying anything about memes, and they talked about it not once but 3 times. And so it's really talking about the risks. It mentions IPOs, SPACs, and meme stocks. And it's interesting, it also comes on the day, of course, this report came out after the close, but IPOs actually saw a big drop yesterday. So it's not necessarily that investors are wringing this excess out of the financial markets. Perhaps it's going into other places like Bitcoin, but still it's enough for the Fed to be raising a warning. Now, folks over at the Cato Institute like George Selgin would say, look, it's kind of contradictory that the Fed is talking about this when the consequences of their easing of low rates is that we see excessive risk taking.
Danny, speaking of froth, we've also seen the popular ARK fund continue to stack up losses.
Yeah, definitely. And again, it kind of goes with that trade yesterday of the IPOs, the really high flyers starting to fall. So we have Cathie Wood's fund here, the ARK Innovation funds in the white. It had done really good, starting to fall. But strangely enough, real yields are also starting to fall. You'd think that that lower picture would help bring growth appetite back in. And Francine, that's where we get this picture that stocks and bonds are not telling us the same story at the moment. Not only are these big tech names, the big perhaps frothy stocks selling off, but we're also getting a move into value. So I want to show you banking versus the yield curve over the past week, because banking stocks actually have done well, but at the same time, we're getting a flattening in the yield curve. So who's right in this circumstances? People like to say the bond market is smarter. Perhaps they think the Fed is going to stay on hold. But again, stock markets showing a different signal at the moment, Francine.
Yeah, Danny, thank you so much. Something to wade into. Danny Berger there with some of the market movements. Now, joining us is James Pomeroy, HSBC HSBC global economist. James, I have questions about valuations. I have questions about what Danny was just talking about, a lot of money chasing yields across the board. And then, of course, it's also jobs in the U.S. Do you worry about, if not asset bubbles, froth in the market right now?
I think it's interesting. We're in a situation where the global economy, the US economy in particular, is likely to grow very quickly this year. Interest rates are low, and that is a favorable environment for risk assets. And it is just the world we're in. And you're seeing this across a whole range of risk assets. It's not just financial assets. You're seeing this in house prices. You're seeing this obviously in crypto markets as well. You're seeing this in sort of a whole range of ways where people are clearly looking for a little bit extra return than the very, very low interest rates they'd get in their bank accounts. And it is an encouraging economic environment that is backstopping that, not just lower interest rates.
But is there a danger to that, James? So as long as things go up, that's fine. But at some point, if there's normalization in interest rates, or we even talk about tapering, what happens in the market? So we're going to see a temper tantrum.
You could, of course. But the big difference is you've got, at the same time, you could see slightly higher interest rates and people could start to rethink some of these investments. But at the same time, as I say, you have got this big economic reopening and this strong economic story. So you could see certain parts of financial markets fare slightly worse. And that could be part of the reopening story. We had a year where people have been spending a lot of money on goods, a lot of money on digital consumption, using Facebook and using Netflix and using Spotify much, much more. And if we all start going back out to smaller cafes and restaurants, then that changing shape of the economic recovery could play into financial markets as well. So it could spook investors, but I think it's part of the story, but there's a much bigger story going on here, which is sort of supportive of demand and supportive of risky assets, which is this big economic boom that we're seeing.
Yeah. Is the boom at risk of actually leading to an overheated economy? So we have the jobs report today in the U.S. What are you expecting?
So we're looking for just shy of 1 million jobs, and that seems to be pretty in line with what the market's saying. But I think the really interesting thing to watch here is what happens with the recreation and leisure sector. And then that's the part of the economy where jobs have been most beaten up, unsurprisingly, given the lockdowns that we've seen. And those number of jobs are still about 20% lower than they were pre-pandemic. So there's a lot of gap to be closed in. But that's also the sector that you probably see the biggest sort of pickup as the economy reopens. So I think it's a really good indicator of how quickly businesses are trying to bring people back, how quickly we're seeing spending pick up in those sectors. And I think actually the jobs number itself is going to be very interesting, but some of the sort of niche details underneath it could tell us a lot, not just about how the US economy did in April, but also setting us up for May, June and beyond.
Do you believe inflation will be transitory? We were speaking to, or Matt Miller had a conversation, for example, with the new Siemens chief executive who, because of commodity prices, is going to pass on price hikes. I mean, these are price hikes that will probably never be reversed.
It's possible. I mean, what's been really interesting in the past couple of months is if you look at some of the PMI numbers, if you look at those input price indices, particularly in the US, they're incredibly strong. On the manufacturing and on the services side. So it suggests that businesses are feeling these huge cost increases. And it's not just base effects, because they're increasing every single month. We're seeing these higher costs coming through, and it's these shipping costs, it's commodity prices, all of these things which are hanging around. Now, as you say, the big question is how much of that is passed on. And at the moment, the things like the output price indices are not picking up anywhere near as much. And in certain sectors, we will see some pretty clear inflationary pressures in the course of 2021. It's those sectors that have had beaten up supply, where there's not as many flights, or there's not as many Cornish cottages here in the UK, or nice hotels in certain parts of the US where people want to go and travel domestically. You're going to see these big pick up in inflation. You're seeing it. The best example for me here is garden furniture in the UK. Huge demand, huge lack of supply, huge inflation. But across the board, the broader set of goods inflation we think does fade in the second half of the year, because a lot of these effects that are pushing up goods prices are relatively short term. And if they do fade, you should see that goods price inflation fade a little bit in the second half of the year. That going against that service price story probably keeps inflation higher than it had been pre-pandemic, but probably not high enough, sort of around the 2% mark, to mean that central banks, including the Fed, are not feeling real pressure to keep hiking. So what we think we do see is this pickup in inflation is relatively transitory, but inflation does stay slightly higher than previously in the second half of the year.
James, thanks so much. James Pomeroy there of HSBC stays with us. Now, coming up, the UK economic recovery gathers pace, and the Bank of England just slows its bond buying program. Up next, the Governor, Andrew Bailey, tells us that a major shock would have to happen for the central bank to reverse course. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
To have some, severe disappointment in terms of the outcome. So an obvious case in point, unfortunately, sadly, would be the return of COVID in a big way, which caused further economic dislocation. Now, we're not forecasting that at the moment. We don't see the evidence of that, but it would have to be something that, caused...
Like a shock?
That's, yes, a negative shock of some sort.
Well, that was the Bank of England Governor Andrew Bailey on why he would need to see some kind of negative shock before considering expanding QE next year. Now, James Pomeroy of HSBC is still with us. James, I had a conversation with Governor Bailey yesterday, and I tried to understand from him whether he'd be one of the first central banks to actually taper into next year or after beyond, even before the Bank of Canada or not. Does it make a difference of who goes first?
Probably not really. I think what's most interesting is the rough direction of which central banks are sort of positioning themselves on that sort of dove-hawk spectrum. And the Bank of England is clearly pushing itself towards the more hawkish end of that, not pushing back on market pricing of some tightening, talking about some tapering to come, and all of that together does put the Bank of England at the more hawkish end. And it's sort of, there's a whole load of reasons why they can be hawkish, and it's some of this economic recovery we're seeing. Some of it is the incredibly good vaccine rollout here as well. So there's room for optimism for the UK, and that fits in nicely into this relatively hawkish Bank of England. The exact timing is not too important. It's more about sort of where central banks are positioning themselves on that spectrum.
The political, I guess, ramifications of an independent Scotland and things like that will have a huge impact on the economy of this country. Is this one of the bigger shocks, actually, for the Bank of England, I guess, away from COVID-19, which has been pretty, well telegraphed?
Yeah, most definitely. I mean, any sort of political uncertainty, as we saw around the Brexit sort of story over the past 5 years, can weigh on the economic recovery. And it's that uncertainty that hurts investment, it hurts trade, it hurts all of those things, including sort of employment as well. And so, yes, the UK is in this slightly odd situation at the moment where the consumer recovery is likely to be pretty strong, but the risks in terms of investment and uncertainty are relatively high, both in terms of the spillovers from Brexit, but also any uncertainty around Scottish independence could add to that too. So it's sort of it's not sort of a clear cut sort of this is how much it would take off growth, etc. But it's that weighing uncertainty that we think holds back investment partly this year anyway because of Brexit. But any additional uncertainty wouldn't do the UK recovery a lot of favours.
James, what does the UK economy actually look like in 2-3 years?
Hopefully, it's grown quite nicely. I mean, the UK has been a consumer recovery as a consumer economy for quite some time, and the consumer recovery we're seeing at the moment is hopefully going to continue to create jobs and to grow back a service sector. And clearly, the government here wants to try and sort of upgrade a lot of our industry, want to be much more tech focused, want to create jobs in those sectors. And if that can be done, the UK can do relatively well in the coming years. But the big challenge is going to be, can we sort of keep generating jobs at the same pace that we had done previously? Can we keep investment coming into the UK? And it's a much more uncertain outlook for the UK than probably many other economies in the world at the moment. So hopefully it's one that has diversified a little bit, has got a lot more jobs in high-tech services, and it's one where jobs are back and the economy is growing nicely. But it is likely to be an economy where we're not expecting this as rapid complete rebound from the pandemic as we are in the US, just simply because of some of those risks that are out there in terms of investment.
Sometimes, James, when you look at how markets are priced, it seems that we forget that there are many variants of COVID, certainly ravaging India and other parts. Again, how does that play out?
I mean, it's a clear risk. The better news for the UK is that so far the evidence is that the vaccinations that we're using are relatively good against a lot of the various variants that are out there. But it sort of weighs on the economy in two ways. One is it creates that risk that we could see at some point down the line. We could see more lockdowns. We could see more restrictions. That means businesses across the country are going to be a lot more conservative about their employment plans, about their investment plans, until we almost know for certain we're out the other side of this pandemic. But it's also worth noting that because of these sort of variants across the world, these slower vaccine rollouts across the world, borders are going to stay relatively closed for some time. And that's actually could be relatively good news for the UK in some senses, because if we do see consumers in the UK being unable to go overseas, then their holiday spending may be spent locally, and that could help to support UK domestic spending as well. So there's a number of ways it plays out, but of course these big risks that are still out there in the global economy do come back to the UK, and that uncertainty probably holds back a little bit of the rebound, just because businesses are so uncertain about whether we go back into lockdown.
James, thank you so much. James Paul Murray there from HSBC. Now let's get straight to the Bloomberg First Word News. Here's Leanne Garrett. Hi, Leanne.
Hi, Francine. There are doubts that a patent waiver for COVID-19 vaccines has enough support. German Chancellor Angela Merkel has come out against the idea, with a spokeswoman saying it would create severe complications for vaccine production. It now falls to the World Trade Organization to take up that debate, but officials warn the talks could actually take months. Now, Wall Street's new overseer has laid out his agenda for increased regulation in a number of areas. Securities and Exchange Commission boss Gary Gensler made his first appearance before Congress since being sworn in. He pledged to look into the wild price swings of the GameStop saga, cryptocurrencies, and the derivatives that triggered the Archegos blow-up. And Bloomberg sources tell us the UK plans to offer under 40s an alternative to the AstraZeneca vaccine. That's due to concerns about blood clots that affect a tiny proportion of those receiving the shots. The decision could be announced as soon as today and comes as officials prepare to open vaccinations up to those who are aged under 40. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, coming up, keeping the pressure on China, the Biden administration is likely to proceed with the investment ban imposed by Donald Trump. We'll bring you our scoop next. This is Bloomberg.
sort of technology landscape have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get to the Bloomberg scoop. And the Biden administration is likely to preserve limits on U.S. investments in some Chinese companies imposed under Donald Trump. Bloomberg sources say the talks on the ban are still preliminary. Wall Street has been urging the Biden team to roll back the restrictions. But speaking in Louisiana last night, the president said the U.S. needs to remain competitive.
Chinese are eating our lunch. They're eating our lunch economically. They're investing hundreds of billions of dollars in research and development. That's why right now, if it keeps going the way, they're going to own the electric car market in the world. They're going to own a whole range. We got to compete.
Joining us now for more from Hong Kong is Bloomberg's chief Asia economics correspondent, Enda Kura. Enda, thank you so much for joining us. What does the news on the investment ban signal for U.S.-China relations?
Well, I think, Francine, it's a continuation of a theme. This was a measure brought in, a quite hawkish measure brought in under the last government under President Trump, and it essentially targets U.S. investments in certain Chinese companies that have links to China's military. Now, when it was first announced last year, there was some confusion around which companies would be impacted and how it would be implemented and so on. So there was some thinking that with the new administration, that perhaps this might be one of those policy areas where there could be some wriggle room between both sides. But the indications are now, as you mentioned, as our colleagues are reporting, President Biden looks like he's considering doubling down on this. It does speak to the idea that there hasn't been much change of tone really at all in the U.S.-China relations. The tensions continue over technology, over human rights, over economic competition. This idea now about targeting U.S. investments in certain Chinese companies just adds to the theme that there isn't really a circuit breaker in the U.S.-China tension just yet, and it looks like it's going to continue in the near term.
And China has also reported strong trade numbers. So what's the big takeaway from that?
Well, these were bumper trade numbers, Francine. Of course, there's a base effect, but when you look at them, exports grew over 30% in dollar terms in April from a year earlier. Imports up over 40% as well. It speaks to the idea that the world economy is rebounding as it opens up again. We know that global appetite for Chinese merchandise goods is very strong, and that's being backed, of course, by so much public support for economies around the world. And when you look through the figures, you can see big export growth, in particular, in fact, to the U.S. U.S. was China's biggest export market in the month, accounting for almost 16% of Chinese goods sold abroad. So really shaking off the impact of a trade war. On China's imports, it's a strong headline number, but we do need to remember, of course, the big run-up in raw materials prices and commodities prices, which is inflating that. But all told, these are a robust, if not a bumper set of China trade data, and it speaks to a recovering global economy.
But the stronger the recovery in China, and does it make it likely that actually they can take on the U.S. more, or are the two unrelated?
Well, I think there's no doubt that China is in something of an economic sweet spot coming out of the virus now, Francine. As you know, I mean, they got it under control early in 2020. That allowed their manufacturing and industrial production to get going earlier than rivals. And they continue now to be in a strong place to capture the demand from the rest of the world as it opens up, as the U.S. gets booming on the back of stimulus there, and as Europe gets going again. China is in well placed to make and sell all of the kind of merchandise goods that the world needs. It's everything from work from home kit to all of course the medical equipment that the world needs right now to fight the virus. So China, was obviously hit hard early on, but they've ended up in something of a strong spot. The recovery there is beyond, of course, the industrial and manufacturing base. Services and consumption is slowly recovering too. And even if there is a view that China's recovery may plateau or cool somewhat over coming months, all told, they're in pretty good position at the moment.
Yeah.
And certainly puts them on a good base when it comes to competing against the US.
And thank you so much, Arnda Kern. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Rising risk appetite becomes a concern for the U.S. Federal Reserve. The governor, Lael Brainard, says more granular disclosure may be necessary after the Archegos debacle. Bloomberg learns that President Biden is likely to keep up the Trump-era limits on Chinese investments. And Cathie Wood's ARK Innovation ETF slide another 3% as inflation fears take hold of investors. Coinbase plunges to its lowest level since last month's IPO. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, English election results are coming in with the northern town of Hartlepool going to the Tories for the first time since the constituency was created in 1974. Scots are also waiting on tallies, which could pave the way to a second independence referendum. Well, joining me now to talk about all things UK and politics is our executive editor, David Merritt. Dave, good morning to you. I know you also helped us, of course, follow Brexit from the very beginning, and this is kind of a continuation. First of all, if you look at the UK as a whole, I guess the biggest concern for Boris Johnson is how he keeps the union together. Which way will Scotland go?
That's right. That is the kind of bigger question politically, but also for financial markets. about this election. Yes, that Hartlepool gain is very striking and shows Boris Johnson continuing to make inroads where the Tories never have before in England. But in Scotland, we're not going to get any results actually for this today. The counting's all been a bit delayed from normal processes because of the coronavirus restrictions. So it's probably not going to be till the weekend. Now, we know that the Scottish National Party's Nicola Sturgeon is going to win. There's no doubt about that, but it's the scale of her victory that's going to be crucial. If she can get an overall majority in the Scottish Parliament, that is going to give her fuel to demand another referendum about Scottish independence in the course of this Parliament. It might not happen this year, but in the coming years. And that, of course, has huge consequences for the entirety of the UK. Polls showing it really neck and neck whether she would win that or not.
I'm looking at Hartlepool. I mean, this is, swinging to the Conservatives from Labour for the first time. What exactly is the implication of this? First of all, is it all about vaccines?
That's right. There's a few things going on here. There's obviously Brexit. This was a very Brexit-supporting bit of the country, but also there is this bump coming on from the vaccines. Coronavirus numbers are plunging. People are feeling good about the economy unlocking. So Boris Johnson riding a bit of a wave for that. But it is remarkable for an incumbent government to win a seat like that. Very bad news today also for the Labour Party and for Keir Starmer.
What does this mean about, the popularity of Boris Johnson right now? So is it a vaccine rollout that actually he will almost be forgiven for anything? I mean, there's the, curtains for cash scandal. There's the Greensill concerns. Is that going to be forgotten by the citizens in Parliament? It
is amazing, isn't it? Seemingly he can do no wrong when it comes to the voters. But in so much negative press, hasn't there, over the last few weeks? This so-called sleaze allegations against him, who paid for his flat redecorations, all these money problems. The voters don't seem to care. The Labour Party seem to have made a big strategic error here, focusing in on that negative campaigning, when actually the bigger picture is, as I said, the economy is reopening, the sun's coming out, people have been vaccinated, the majority of people, and people seem to still, in England, of course, this is not the story in Scotland, but in England, they still seem to like voting for Boris Johnson's party.
What's his biggest challenge away from, there's Scotland, but at this point, Dave, if he's doing okay and actually despite some of the sleaze scandals, he's still winning in certain parts that had never voted Tory before, does it embolden him? Does it change the way that he wants to govern this country?
Well, this was part of the agenda that he has about levelling up. That's a big part of this strategy to grab these seats in the north of England. But of course, he's got a big problem on his hands with this, which is how to pay for it. We know we've had, the public finances are in the worst state that anyone can remember, the deepest recession in 300 years. So how do you pay for infrastructure? How do you level up, as his agenda has it, when there is no money in the Treasury? And at some point, there needs to be a financial reckoning. It's a question for Rishi Sunak, of course, but as we come out of this huge economic slump and the economy recovers, how much money is there going to be available to pay for all of these promises that he's made to those seats? Because he's going to have to stump up some cash in order to convince people that he was telling the truth. And in fact, he does have a levelling up agenda. So time will tell for that over the coming years.
I know we spoke a lot about, the fish fight raging on with also Navy ships being sent to Jersey. What did you make of it? And are we going to have these skirmishes that frankly surprise many, because this is the UK and France we're talking about?
Yeah.
Are we going to have this sporadically?
Yeah, war with France probably not on the agenda at the moment. It's all a bit of posturing, wasn't it? Great headline grabbing. Boris sends in the gunboats to defend Jersey. But it is a symptom, isn't it, of how tetchy relations still are with the European Union. Brexit may have been done in terms of the trade deal, but, the wrangling is going to continue. And whether it's about fish or whether it's about things like financial services, a lot of these issues still have not been resolved. And I think it's a sign of things to come for many years, that Britain and the EU are not going to have this very cooperative relationship. Perhaps for some time there's going to be tetchiness, there's going to be spats, but of course that plays quite well politically for both sides of the channel. Mr. Macron, of course, is up for election himself next year in France, and no side wants to be seen to be caving into the other. Unfortunately, that means a little bit more economic turmoil, perhaps, particularly when it comes to things like financial services in the years to come.
Dave, thank you so much. I have to say, Dave, one of our opinion columnists, Therese Raphael, who's very good and very funny, just tweeted something. Which of these is more likely to have hit rock bottom, Arsenal or the Labour Party. So we'll have to get you back on to discuss that as well. David Merritt there talking about the election, Scotland, and the future for Boris Johnson. Now, the world of sustainable investing has ballooned in the last 5 years from a fringe corner of the market to a significant portion of the market. New analysis by Bloomberg Intelligence suggests that ESG assets can make up more than a third of global assets under management by 2025. That's more than $53 trillion. And though Europe accounts for half of the ESG assets currently, the US would overtake the region by as early as 2022. Well, joining us now is Marie-Jacques Cardoen, Edmond de Rothschild Asset Management Global Head of Distribution. Marie, as always, thank you so much for joining us. I think it's the first time that you come on Bloomberg Surveillance. When you look at the appetite for ESG, there's been a big wave, especially in last year. What are your clients asking that actually asset managers provide in terms of ESG, and how much will that grow in the future?
Thanks, Francine, and thank you so much for having me. I think you're right. The last year has been a pivotal year in terms of investment in ESG. It's accelerated certainly the interest and the commitment to sustainability, and we've shown flows in European ESG funds, for example, doubled to reach 230 billion. And we've seen, I think, 500 new ESG funds launched. So definitely a huge interest from investors in Europe. And of course, we're also witnessing new regulation that encourages flows into ESG, in particular to meet the EU goal of a net zero economy by 2050. But of course, there was the European Commission SFDR implementation in March this year, and that has prompted asset managers to classify and categorize their funds in terms of how they score from an ESG perspective. So, for example, at Edmond de Rothschild, we now are reporting that 85% of our products are Article 9 or Article 8, and that's really something that investors are asking for.
Marie, is there a concern that actually a lot of investors will then get confused because they say, well, you know, we're being sold products, but I don't know what we are on taxonomy, that because we don't have common definitions, because actually almost each company, certainly each region and country look at things differently, until we get a more robust framework, that it's going to be touch and go.
That's right. And I think the reality is that most investors are not only looking at the risk-return ratio now, but they're really looking at risk-return and impact, or risk-return and purpose when investing. And they're faced with a couple of challenges still, and they're mainly linked to two things. I think the first thing is the definition, as you say. It's still really difficult to identify and define the universe, because there is no real consensus about what ESG really entails. That explains why it's so critical for investors to be able to get access to meaningful data and metrics. And so what we've done at Edmond de Rothschild is we signed a UN PRI, but we've also decided more than 10 years ago to actually build our own proprietary model where we use more than 50 criteria that we review on a regular basis. We've also incorporated the 17 Sustainable Development Goals from the UN, and we're using that model to be able to assess, to measure, and to score companies from an ESG perspective, and then use that when investing in stocks in our portfolios. So that approach, proprietary approach, is fully integrated in our portfolios. And that's a way to differentiate. The other thing that I think investors are struggling with, and that comes up quite regularly in the debate about ESG, is performance and whether or not ESG is generating alpha. And look, when we look at studies, and our own experience is that ESG creates a virtuous circle in the long term. Our experience is that companies that score well from an ESG perspective are financially performant in the long term. They tend to be more resilient, and as we've seen last year, they also provide a good downside protection in times of crisis. The interesting thing now,
No, finish, and then I have another question.
I was just going to add that from a risk management perspective and innovation and incentivization, I think it's also interesting to see that ESG, companies that score well in ESG tend to perform better. Now, you talked about mainstream and you talked about, a lot of investors going into ESG. I think one point that's interesting to see is that portfolios that are, fully ESG integrated, when we look at data, tend to perform better than those who are integrating an approach that's purely based on negative screening.
Mike, very quickly, do you see a shift from climate change to also the most social aspect? So because of COVID, because people are much more aware about diversity, people in the workforce that have been displaced because of COVID, do you see that opening up as a space for investors?
Yes, certainly. Certainly the crisis has led to the social aspect in the ESG context to become more prominent. And look, the spotlight is really now on companies' social practices, on how they treat their employee and their safety and health. Have they maintained wages during the crisis? Do they have insurance schemes in place for their employees? And that's, I think really interesting in the context of more broadly human capital and how being best in class in terms of managing human capital as a company is also creating added value. It's a topic that hasn't really emerged last year. It's been a catalyst rather last year, but studies had started way before. And what's interesting is that if you look at the last 25 years, the annual average alpha that's created by companies that have a best-in-class human capital approach is around 3 to 3.5%. So we've launched a human capital strategy to give investors access to that added value, and I think that's really exciting.
Marie, thanks so much. Marie Jacot-Cardoen, there, Edmond de Rothschild, Asset Management Global Head of Distribution. Now, coming up, the co-founder of Atomico, the VC behind Klarna, Viagogo, and Stripe, has a new venture. We talk next to Matthias Lungman about his new Moonfire fund and the philosophy behind Zoom investing. This is Bloomberg.
On Tuesday, Bloomberg Technology brings you a special look into the recovery and renewal happening in Boston. Hear conversations from business and political leaders, including Moderna co-founder Noubar Afeyan, Bain Capital co-chairman Steve Paliuca, and Boston interim mayor Kim Janey. Catch the Bloomberg Technology Special on Boston's recovery, Tuesday at 5:30 p.m. on Bloomberg Television.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Moonfire Ventures has just launched its first seed fund. The company, started by Atomico co-founder Matthias Lungmann, has raised $60 million. Formed in 2020, Lungmann went through the process of founding, raising capital, and investing entirely remotely. Now he's using that experience to do what he calls Zoom investing, which is data-driven venture capital that looks to leverage the change in behaviors caused by the pandemic. Well, I'm delighted to be joined by Matthias Lungmann now. Matthias, thank you so much, first of all, for joining us. I know yesterday was a big day for you. I guess today, day two, is also another big day for you. How will this be different to Moonfire 1.0?
Yeah, so it's wonderful to be here. Thank you so much for having me on the show again. It's exciting times in tech, and as you said, we're sort of seeing a booming of the sort of next generation of European founders coming out, and for us, we've also seen a big change in that there's literally a sort of a death of geography where people are focusing, on Zoom investing, and for us, that's come very naturally as we were born in the sort of era of the pandemic, where we built the whole firm, brought in investors, and raised a fund in this new world.
So, Matthias, how do you see our worlds changing? How will we, I guess, what we've lived through in the last 12 to 14 months, the fact that we communicate like this, that we do television interviews only by Zoom or Skype, that we communicate in meetings, how much of that will change once we go back to maybe a more normal life? And I don't know whether normal is the right way of describing it either.
Yeah, look, I mean, it's clear there's a bifurcation of the economy, right? Where we're seeing that there's one component of the economy, the older part, which is actually struggling in this current environment. And you're seeing the tech side really continuing to grow. We're seeing one new unicorn being created in Europe every week. And in sort of, we're sort of fit for purpose. So the areas also that we are focusing on, fintech, future of work, gaming, and e-health are all seeing a big pickup, and like you mentioned, what is happening in the world of future of work, and we can definitely see a dismantling of the traditional way of thinking about work, and how we work, where we work, and what we do is very different today, and I think that's going to continue. I think the pandemic just all it did was move things forward much more quickly than what we had before, but that was a trend that was happening anyhow.
But so how do you explain this boom? Is it just accelerating, I guess, the trend that we were seeing before? Or is there something exciting about the European, tech scene, startup scene at the moment?
Well, look, the numbers almost speak for themselves. In the first quarter of this year, we had 21 billion euros of exits. That was a lot bigger than all of last year. We had a further $20 billion invested in Q1 compared to 40 billion last year. So, why is that happening? And I think that's a really good question. And ultimately, what we're seeing is the compounding effect of many years of growth, faster growth in Europe than what we've seen in the US and in China, suddenly coming into play. And what you're having these big outcomes where, you had UiPath listing recently, now worth $37 billion. And you have Adyen up at 60 billion, and the same thing with Spotify. And they're creating the next generation of founders. So not only do you have more billion-dollar companies, but they're also the depth and strength of those big companies are providing a good breeding ground for the new generation of founder.
Is there a difference now between European tech or European startups and the US? I was, in the past, one of the concerns was that there was just not enough money for that critical mass kind of expansion in Europe, which we saw in the past a lot of big companies always coming from the US. Is that changing?
I think we're seeing that beginning to happen now properly. When you're edging towards $100 billion companies, tech companies in Europe, it's really exciting, and I think the reason why things are growing so quickly here too is because we're getting that international interest. There's a lot of both Eastern and Western investors, but people coming from the Silicon Valley looking at our companies, interested in what's happening here, and it's the shift that happened during the pandemic was enormous, and so they're definitely engaged in Zoom investing, and many of them are also setting up shop here in Europe. So you have Sequoia, Lightspeed, General Catalyst, all opening up offices. But I'm looking when I'm bringing companies out, when they're looking for their next round of funding, you know, what used to be 20%, let's say, U.S. investors is now moving up to 50 to 70%. And that's all really good for the founders and our ecosystem as more money is going in and helping to breed the next generation of innovation.
Matthias, thanks so much. Matthias Lungman, there, Moonfire Ventures founder and managing partner. Now, coming up, Doge and a pony show. We discuss why a comedy show on Saturday night is shaping up to be a market event for crypto traders. This is Bloomberg.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London. Now, let's have a look at what's going on with a lot of these pharmaceutical companies. Yesterday, you remember, if you look at BioNTech and some of the others, they really fell out of bed. I mean, that's a very British expression, but they were sold because we understood that the U.S. was behind this waiver of IP. This would be a good thing for global inoculations. Bad news from some of their shares. But we now understand that actually Angela Merkel in Germany would be behind intellectual property being kept for vaccinations. So we're getting a little bit of a boost for some of these vaccine makers. Now, let's talk about crypto, because every Doge has its day. This week, it could be on Saturday when the self-proclaimed Doge father, Elon Musk, hosts Saturday Night Live. Now, ahead of his appearance on the American comedy show, Dogecoin has staged a massive rally to become the fourth largest cryptocurrency. I could talk about it all day, and our Danny Berger is here to break it down. Danny, I mean, let's think about this. Are we really at the point where we can say SNL is now a market event?
Yeah, we are at that point somehow, Francine. And look, just to put this out there, and maybe this speaks to the times too, I'm way more used to bringing you some like esoteric options thing up here, not this video of Shiba Inus. So I think think, you know, this is an interesting change for us as well here. But look, we are. I think, you know, this new culture of meme investing is a lot behind Elon Musk. Elon Musk really epitomizes this sort of idea we're investing in meme. I mean, look, this is what he tweeted out last night, as you said, calling himself the Doge father, promoting his SNL appearance. So by all accounts, everyone is saying, okay, he's going to have some sketch about Dogecoin. People are going to jump in. They're going to go buy it. And we're getting this viewpoint from very serious market analysts. This is from Edward Moya of Awanda, who usually is talking about like dollar strength or that sort of thing. Mike Novogratz had a 22-page report on Dogecoin recently. But, you know, as much as people try to take this seriously, I don't really think that's the approach here, because the reason it does so well, the reason it's so valuable is because of its meme status, is because it is really fun.
Yeah, and it's a very cute dog as well. Yeah. I don't know, what is there an implication for other cryptos?
I mean, I think that there is some concern in the wider community that if you take this as a joke, then, you know, how do you take Bitcoin seriously? I don't think that that's a welcome attitude, really.
All right, we need to talk about this even more, and we're definitely watching SNL this Saturday because it's a market-moving event after all. Danny, thanks so much. Our Danny Berger there on crypto and Dogecoin. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins us out of Berlin, Katie Lyons in New York. It's Jobs Day. We'll look at, of course, what we heard from Lael Brainerd of the Fed. We also look at vaccine makers. This is Bloomberg.
The interesting features about this illness is that if you look at it, the people who develop these long haul symptoms are often not the individuals who are hospitalized and were sick and on a ventilator and stuff like that. These are individuals who actually, most often, they never went to the hospital. They had a relatively mild illness in the acute phase, and they recovered from it. If you were in the hospital, it means you probably mounted a very strong immune response, okay? And you recovered from the illness, you probably got rid of the virus. If you never mount a strong enough immune response, then what happens is you may have mild symptoms. You thought, oh, you know, I escaped this. But in reality, you never got rid of the virus. So you get this chronic immune activation that persists in these individuals. But it's never good enough to get rid of it because they never got rid of it in the first place. But it's enough to start causing collateral damage. And what the virus does is it inhibits certain types of immune responses. It's a drain on society at every single level. I mean, it affects women more than men. It affects people in their average age is 40. That's the most productive years of your life. And so you can see that the impact, worldwide impact of this is unbelievable. Economic toll, the psychological toll, every aspect of society is going to touch.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is basically going to kick off the whole week.
From bank earnings really have to be front and center, to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
We're also seeing a really strong recovery.
No one delivers the data faster.
Nestle's out with numbers. Can this company continue at this kind of clip?
Bloomberg Television, your home for earnings season.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
every single thing, from the deck of an aircraft carrier to a railing in a new building, is going to be built by an American company.
We have some capacity to expand production, but eventually we will reach capacity constraints.
We've been clear today, we have not changed the stock of quantitative easing that we're doing this year. So what we've changed is the pace at which we achieve that stock.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Well, good morning from London, Berlin, and New York on this Friday, May the 7th. Our top stories today. Million job milestone. Today's jobs report is likely to show that easing restrictions are bringing more Americans back to work. This comes as the Fed warns of rising risk appetite. This ARK has hit the rocks while Cathie Wood's ARK Innovation ETF falls another 3%. The fund's being hammered by a slump in highly valued tech shares. And Biden stays a course that was set by Trump. The U.S. is likely to maintain pressure on Beijing by keeping those limits on American investments in key Chinese companies. It's Jobs Day. Happy Friday, everyone. But I don't know whether, Kayla, we can say happy Friday until we get the jobs report out of the way. It was give us, of course, an indication of what the Fed does. And then I'm really looking forward also to Matt Miller's interview on inflation with Siemens, because you see a lot of these companies, you know, pushing the price hikes through to customers. But overall, Kayla, it's actually quite a big market day.
Yeah, it absolutely is. You have that inflation story, you have the labor market. That right there is the Fed's dual mandate. So the market really in a holding pattern, waiting for 3.5 hours time when we get that read. As for what the picture looked like in the Asian session overnight, you did have some stocks higher, including Japanese equities just marginally, but you did have Chinese stocks down 1.3% and Hong Kong stocks under a bit of pressure as well. Now, you did have strong trade data out of China, imports and exports surging, but risk appetite being weighed down a bit by what Francine just mentioned, the Biden administration potentially keeping that investment ban in Chinese companies in place. I would note that Chinese yuan is stronger against the dollar by around 0.2%. The Japanese yen, though, slightly weaker, sitting at 109.15. As for what the picture looks like in another region of the world, in Europe, it is mostly green across the screen. You do have a little bit of underperformance coming from the CAC in Paris, but the DAX higher by 1 percentage point, and the Stock 600 up by about 0.4%. I would note that in foreign exchange, euro-dollar is approaching 121. We aren't there right now, but the euro is stronger against the dollar, sitting at 120.86. And in the commodity complex on the London Metal Exchange, copper, a new all-time high right now, trading at $10,263 as that commodity rally rolls on. As for what the picture looks like in the U.S., futures have been fluctuating a touch, but at the moment they are in positive territory, up 5 points on S&P E-minis. Not a lot of action in the Treasury market. Again, we're awaiting that jobs report. The 10-year yield sitting at 1.57%. The dollar flat to slightly down. And of course, the Bloomberg Commodity Index higher for a 6-day, Matt, and the Bloomberg Commodity Spot Index at its highest since 2011. Commodities still just the hottest thing out there.
Yeah, and you know, this is a huge part, Kaylee, of my interview with the new Siemens CEO. This is a very global company with more than 200,000 employees. They sell products to everybody in automotive, medical devices, power generation, and they need those commodities, right? So as those prices rise, Siemens has been able to increase prices to customers, and those aren't the kind of things that they turn around later and reduce. So those are not transitory price increases if you're buying Siemens stuff, and if you're a giant manufacturer, you probably are. Let's take a look at what's going on today. Of course, it's all about the U.S. April jobs report. Even the low end of expectations is still pretty high, over 800,000. We're going to get the numbers at 8:30 a.m. New York time. Then following that report, Mike McKee is going to speak with the Minneapolis Fed President Neil Kashkari. Very dovish. We'll see what Neil has to say. Then we're going to get the Biden administration's view on the report with U.S. Labor Secretary Marty Walsh at 9:45. So, Fran, this should be a very big number. It could be over 1 million jobs added. And the question is, do we continue in this direction? Because as you know, we're going to speak to some people on this program today who think, once again, that growth may be peaking in this quarter.
Yeah, I guess this is the trillion-dollar question that will, of course, underpin everything. Is at some point, is the economy overheating? And if it is, what does the Fed do? Now, the Federal Reserve, Matt, also warning over asset prices in its semi-annual financial stability report. It says rising appetite for risk across a variety of asset markets is stretching valuations and creating vulnerabilities. Well, joining us now, Danny Berger with the very latest. Danny, what seems to be the consequence of the Fed bringing up, once again, it's not the first time, asset prices?
Yeah, well, I think this time, it probably does surprise investors to some extent because they were already surprised when last month Powell used the word frothy. Well, this time they're talking about meme stocks, not once, not twice, but 3 times they mention meme stocks in this. So it's really as close as they could get to talking about there being a bubble in markets without actually saying the word bubble. So here are the 3 kind of different categories that they mentioned. So, I mean, what do you go about doing this? I mean, we've heard from Kaplan a couple weeks ago who talked about perhaps, this brings into question asset purchasing. But Powell has been very clear that this isn't enough to make him tap on the brakes. And to that, someone like George Selgin from Cato Institute would say that there's something contradictory about this if the Fed is warning about this excessive risk-taking, which has been caused by the Fed's very easy policy.
Well, Danny, I look at what you have up there on the screen, IPOs, SPACs, meme stocks, all of those have come under pressure within recent days, including the ARK Innovation Fund, Cathie Wood's flagship.
Yeah, you're right. That ARK fund falling again, the IPO index falling pretty heavily yesterday as well. And so I think that this perhaps stops short of maybe what the Fed wants of investors wringing excess out of the market. But something strange is happening in that these stocks are falling. Concerns about valuations, concerns about inflation, maybe concerns about Matt's interview with Siemens about raising prices and passing them on to the consumer. But the bond market isn't doing that. Real yields are falling. That's not bringing back growth appetite. And if you look at what financials and the yield curve have done over the past week, financials have a bid, but the yield curve has been flattening. So bond market's saying something very different than what equities are saying at the moment.
Danny, how are you going to watch Elon Musk on Saturday Night Live? That's like 4:30 a.m. London time, 11:30 Saturday night. Are you going to wake up early on Sunday?
No, I'm staying up. I'm going to get a cup of coffee. I'm going to have my CoinDesk monitor up, watch and see what Doge does. I'm ready for this. I'm very ready for this.
Spoken like a true millennial. Through the night. An all-nighter. Yeah, probably a couple cocktails before that. Elon Musk is on SNL. We are all excited about that. Let's get over to Enda Curran, though, right now, because we have a Bloomberg scoop on China. The Biden administration is likely to preserve limits on U.S. investments in some Chinese companies imposed under former President Donald Trump. Bloomberg sources say the talks on the ban are still preliminary, but Enda Curran, our Asia economics correspondent, joins us now to talk about this. Biden is pretty much holding the course on the Trump-China policies, isn't he?
I think you're quite right, Matt. It's something of a continuation of a hawkish theme. This is a policy they inherited from the Trump administration. If you remember last year, it was rolled out to target U.S. investments in certain Chinese companies that have links to China's military. And at the time when it was announced, there was a lot of confusion about who would be impacted and how it would be implemented. There was pushback from Wall Street and investors, and the view was that perhaps with a change of tone with the new administration, this is the kind of policy that maybe might go back on the table and be looked at again. But the indications, as you mentioned, our colleagues are saying out of D.C. is that President Biden is looking at this again, but they may in fact double down on it. And it just reinforces the idea that there is yet no circuit breaker in the China-U.S. tensions over human rights, over technology, and over the economy. And if they do go ahead and push it through these restrictions, it reinforces the narrative that there isn't going to be any near-term game changer when it comes to China-U.S. relations.
All right, Bloomberg's Enda Curran in Hong Kong, thank you so much. Now, of course, another story we continue to watch is the developments and debate over waivers for patents for COVID-19 vaccines. And it is once again moving the market in free market trading here in the U.S. this morning. Of course, the Biden administration on Wednesday expressed support for those waivers. So we saw a number of stocks come under immense pressure early on in the Thursday session. But then German Chancellor Angela Merkel came out in opposition, and we saw those stocks start to recover. That is once again the case in in early hours this morning. CureVac up by a little more than 7% in pre-market trading. Novavax by 2.3%. And elsewhere, of course, we still have earnings rolling out. Roku topping expectations when it comes to the forecast. Even as the economy reopens, a lot of demand for its streaming video. That stock up the better part of 8%. And Peloton, of course, easing some investor concerns about the impact of the recall, the safety recall of its Tread Plus treadmills. It says it'll only knock about $165 million off of revenue. That is not as bad as feared. And as a result, the stock up 6.5% before the bell, Francine.
Thank you so much, Kaylee. There's so much going on. It's going to be a fun show because we're looking at jobs. We're also all thinking about SNL with Elon Musk and Doge. Now, coming up, Salman Ahmed, Fidelity International Global Head of Macro and Strategic Asset Allocation. He'll have a thing or two to say about U.S. jobs. And then after the U.S. jobs report, Bloomberg's Michael McKee in conversation with the Federal Reserve Bank of Minneapolis President Neil Kashkari. That's at 8:30 a.m. in New York, 1:30 p.m. in London. A possible market-moving interview, so don't miss it. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
We have a price increase in raw materials as well, but also in the freight costs. And in our short cycle business, we put that into our price. So we have a price increase, slight price increase in order to compensate for it. So therefore, I would say this is contained. And you can see it also from our results. We increased, for example, in DI. We increased our margin now in this quarter to a 20.1%, which is an extraordinary margin, but also the margin of SI going up to above 11%. So therefore, I do believe that we have that quite under control, but again, you have to watch it closely.
All right, so Siemens CEO Roland Busch talking with me this morning saying that input costs are rising. They're passing those costs on to their customers, and they're even able to boost margins. So you can guess that they're boosting prices even higher than their input costs are rising, unless they're cutting costs somewhere else so much. That doesn't sound very transitory at all, because they're not likely to cut those prices for their customers later. Joining us to talk a little bit about this and give us his general outlook for the economy is Salman Ahmed. He is the global head Head of Macro and Strategic Asset Allocation over at Fidelity International. Salman, what's your take on transitory?
Good morning, Matt. I think we are skeptical about this characterization of transitory. And just to add to the interview you mentioned with Siemens CEO, we do a broad-based survey of almost all companies in our coverage at Fidelity. And our surveys show that across the board, especially in the US, but across the board globally, we are seeing a big momentum towards increase in input costs, both from labor and non-labor. And there is this idea of pricing power coming back, and it's likely to be sticky in nature. And then, of course, there are supply side issues, but there is also demand side pressure coming up because of the fact that there has been so much fiscal transfers given to the household sector, and it's all looking at underlying inflationary pressures at the very bottom-up micro level, which at least are not still showing up at the top-down level.
But so, Salman, given what you've just said and what we heard from and commodity prices, then there's a very big argument to say that the economy will overheat, and that would put some of the central bankers, or certainly the markets, on a back foot.
Definitely, even though the Fed Chair Powell keeps telling us that he's not ready to talk about the talk of tapering, the only thing we are thinking about is tapering. Because this current Fed configuration and stance looks at odds with the data we are seeing. Of course, the non-farm payroll report will be important to watch as well on that front. But overall, if we zoom out of it, in terms of the new regime, we are thinking about a boom-bust cycle type of regime, because the volatility of policy will have to increase to match the volatility of data and of course, the shifts we are seeing.
So what does it mean for markets? If you look at even the warning from the Fed saying that actually there are just markets that in certain cases, I'm paraphrasing, are mispriced, where do you want to stay away from?
So we have been very concerned about the very high valuation froth, if you will, which was mentioned by Chairman Powell for some time now. So we have been working on sectors which we think have valuation support, will benefit from the reopening theme. Yes, it has been a non-linear, jerky journey, but we still believe in that theme, that the rotation can happen. So we're trying to stay away from some of the expensive parts of the market, and sometimes it gets tested, but we think that is the right way to go, because the Fed will not be able to keep the 120 billion per month pace. They will have to slam the brakes at some stage, and the probability that they will have to slam it very hard is increasing. And then the other side, we are also thinking about bond markets. We are not comfortable with where yields are at the moment. Although the volatility of bond yields have come down recently, we think there is another taper trend shock in the pipeline. So we are already thinking about it and expressing that through our tactical asset allocation grids and matrices.
So in your view, the downside risks are far greater than the upside ones?
At this stage, yes. We think the balance of risk is towards pressure on the market and most likely coming through an increased bout of volatility in bond markets, even though right now it's a little bit of a calm, but we think this is a calm before the storm because the underlying bottom-up inflationary data does not tally up with what the Fed is telling us.
So the idea that growth, earnings, even stocks have peaked sits well with you?
I would actually nuance that, because I think the sector stories are becoming very powerful. So I think where we are focused on is the rotation right now. So to try to think about the areas which are expensive, are linked with the negative real rate environment which the Fed is supporting so far. So we want to avoid that and focus on areas where which is more cyclical areas, linked with the commodity cycle which is going on, and we get, most importantly, we get some valuation support, and we don't have to worry about whether this is expensive or not. So this idea that valuations are high is not sitting well with us in some parts of the market.
Well, Salman, you mentioned negative real rates there, and we've seen them become more so in recent days, and yet we haven't seen the corresponding move in big tech that you would expect. Why that breakdown?
I think this relationship plays out over a longer period of time. So from a day-to-day perspective, this can be quite volatile, and I take your point on that one. But I think the underlying theme is, especially when some of the baskets we watch are non-profitable techs, they are coming under pressure. And then that's the relationship which comes through the negative real environment. And the volatility is also a factor here. So not only real rates have to go up, but if they do go up in a volatile manner, that plays up as well. but it's from a more medium-term perspective, we're still confident that that relationship exists.
Salman, thanks so much. Salman Ahmed there, Global Head of Macro and Strategic Asset Allocation at Fidelity International. Now, coming up tonight, be sure to watch Money and Equality, hosted by our Shonali Bazak and Romain Bostic, a special report on how the financial industry is dealing with inequality in the U.S. economy. That's at 7 p.m. in New York, midnight in London, and this is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance, the early edition of Francine Lacqua in London, Matt Miller in Berlin, Kaylee Lyons in New York. Now let's get straight to the Bloomberg. First word news, and we start with President Biden stunning European allies and drug-making industry with his support for waiving patent protection for coronavirus vaccine. Now that was a reversal of a long-standing U.S. policy that its company's intellectual property is sacrosanct. But there are signs that the president is also interested in a more modest compromise. Meanwhile, Germany has said it opposes a waiver and shares of companies rose on the back of that. JP Morgan Chief Executive Jamie Dimon wants Congress to spell out targets for building roads, funding college degrees, and creating jobs. That's if lawmakers approve President Biden's massive spending measure. In an interview for the Investment Company Institute, Dimon says just throwing money, it doesn't work. This is a quote. He also said that if taxes are raised, there should be an itemized list of how the money will be used. And in China, exports rose more than expected last month because of growing global demand, and imports jumped on surging commodity prices. Exports grew 32% in dollar terms for a year ago. Imports were up some 43%. And finally, the British Prime Minister Boris Johnson has dealt a major blow to his chief political rival. Johnson's ruling Conservative Party won a crushing victory in the parliamentary district of Hartlepool. Now, it had voted Labour every time since the seat's creation in 1974. The loss is likely to intensify pressure on Labour leader Keir Starmer. Now, I know we're going to talk a little bit about also the future of Scotland in all of this, which is probably the biggest worry now and difficult thing for Boris Johnson to deal with. But Matt, overall, if you look at where Boris Johnson is, last week and the week before, we were talking about the sleaze scandal. We're talking about the curtains for cash scandal. And it seems that because of the vaccine rollout, actually, he still has a lot of support, certainly in certain parts of the country, for the Tory party.
Yeah, well, they've obviously done an incredible job with the vaccine rollout, but you would have thought with all of the negative press coverage on the scandals and all of the negative coverage on lockdown, open up, shifting policy, waffling is what we would call that in the U.S., that he wouldn't do, that the Tories wouldn't do as well. It's a real surprise, at least to me, from this vantage point, that he did do well.
Is the sleaze scandal just over now? Are we done with that? Have we moved on? The news cycle changed and, forget it ever happened, Francine?
No, I mean, there's still investigations going. So usually the UK, does these Treasury Select committees pretty well. And he's facing two things, right? First of all, it's donations for the refurbishment of his Downing Street apartment, which is actually quite small and just above the famous black door that you see. And the other one is about, ties to like Screensill and lobbying. But it's very clear that actually if you're a voter, maybe in this kind of case, you remember the thing that they did well in the last time. I mean, you have maybe a short memory as a voter.
Yeah.
Is that the takeaway?
And maybe you don't care if he refurbished his small apartment on Downing Street. I mean, that's not really an issue that affects British people in, towns and hamlets outside of London. It's
maybe the pandemic just tops everything.
Maybe, but then, do you need that amount of money to refurbish a small place? A conversation for another time. Luca Paolini, Pictet asset management strategist, is coming up shortly. This is Bloomberg.
focus is odor detection. And this is because no matter how you're bound, what container you're in, you're still producing and releasing odors. And we're kind of building off of wildlife detection dogs.
Expect clear, concise conversation on Bloomberg Surveillance.
There's no vows in a digital future.
Come on, John, I just think it works.
It works for inverters.
We've beaten this to death. Watch weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance Early Edition on Francine Lacqua in London, Matt Miller in Berlin, Kaylee Lines in New York. Now, it's Jobs Day. I'm quite excited about Jobs Day. I'm also excited about a couple of other stories, Matt, that we've been talking about. But look, Jobs Day will give us an indication whether the economy is at danger of overheating. And, of course, this has implications for the Fed. I'm really looking forward to Michael McKee's interview with Neil Kashkari.
Yeah, well, I'm always looking to hear what Kashkari says. I think he's pretty far out on the dove spectrum, so sometimes he brings us statements that seem kind of out there considering how conservative the Fed usually is. So that'll be cool. Also, the change in non-farm payrolls. The whisper number right now is for adding 1.1 million jobs. So we could see a big number today, Francine. Even if we get the low end of the spectrum, we're still talking about adding more than 800,000.
Yeah, and you wonder, and I know there's going to be then all the analysis of what comes after that, and we can continue on the trend. So, Kaylee, how's it playing out in the markets?
Well, we're really just waiting for this jobs report coming in 3 hours' time, Francine. Of course, Jerome Powell has said he doesn't want to see just one strong payrolls report. He wants to see a string of them. What a string means, I'm not quite sure, but we have to keep that in mind. As for how we are picturing markets right now with 3 hours to go until that jobs report, we are higher in the European session. The stock 600 up by about 0.4%. And here in the U.S., futures are on a firmer footing after fluctuating a bit earlier. We're up about 5 points on S&P E-minis. As for what's going on in the bond market, we're just waiting and watching. Not a lot of action when it comes to treasuries. The 10-year yield sitting right at 1.57%. And then, of course, in the commodity complex, the rally rolls on, and copper, the poster child of that this morning, in the London metal trade, hitting a record high. We're above $10,200. As for some stocks moving in pre-market trading, aside from the jobs report and Elon Musk on SNL and Doge, we also are still in the middle of earnings season, and there are a number of stocks moving on the back of their results. To the upside, Square higher by about 3% in early trading. Its revenue tripled, and part of that has to do with Bitcoin sales, providing a boon to the company. To the downside, though, Beyond Meat missing. It is really struggling as some restaurants and stadiums remain closed. That stock moving lower by the better part of 7%. Also lower is TripAdvisor after its results. And then I would point to the ARK Innovation ETF, coming off 8 consecutive days of losses, the longest losing streak since 2018, down 15% over that time. But at least right now, at this point in the pre-market session, we're fractionally higher, up about 0.1%, Matt. So we'll have to see how things shake out come the opening bell in about 4 hours' time.
Yeah, that's fascinating, the ARK drop. And I'm thinking maybe people who threw their stimmies into ARK and some of the meme stocks or the fast growth technology stocks now are starting to need the money for life, and maybe pulling that out a little bit. It does look like if you've done well in the U.S., you've saved a pretty sizable nest egg. Take a look at this chart, and for those of you listening in radio, I'll just tell you that it goes up on the right side like Al Gore's hockey stick. It's unbelievable the amount of money. 18.8% is the amount of U.S. personal savings as a percentage of disposable income. And the question is whether that is going to be unleashed in a torrent of spending at some point, or whether those people are going to be using it to pay back debt, to invest maybe, to do other things than go out and buy consumer goods and drive the economy. Joining us right now is Luca Paolini, Chief Strategist at Pictet Asset Management. And Luca, you think that growth has peaked. You think corporate earnings may be peaking as well. What do you make of this savings chart, this massive nest egg that not only Americans have built up, but we also see similar figures in the UK and in Europe?
Well, I think, when we look at the consumer spending, you're totally right. I think the amount of potential spending is there, but we already see retail sales well above trend pretty much everywhere. I think there is also a Fed analysis showing that of all these savings, 40% only will be spent. So I think, when you look at the economic data, it's difficult for me to think that, especially in the US, the numbers will get even better. The US economy is overeating. We're talking about a 10% growth this quarter. Can it get really much better without stoking inflation? I don't think so. And this is why I think the risk for markets is actually rising.
Look, yesterday I spoke to the Bank of England Governor, Andrew Bailey, and this is what he said on basically, what would take the Bank of England to add QE next year.
We would have to have some, severe disappointment in terms of the outcome. So an obvious case in point, unfortunately, sadly, would be the return of COVID in a big way, which caused further economic dislocation. Now, we're not forecasting that at the moment. We don't see the evidence of that, but it would have to be something that, caused...
Like a shock?
That's, yes, a negative shock of some sort.
So, look, I guess this is, what markets are focused on is asset prices. It's kind of the talk of tapering and how inflation fits into all of this.
Yeah, I think, look, we're still positive on corporate earnings. So we are not kind of saying that we are entering a new recession or something like that. No, I think the economic data is strong. The problem here is that the markets are priced for perfection. There is a continuation of this strong growth. At the same time, the Fed remaining on the sidelines, which I think is very difficult because inflation is picking up significantly already. And yes, we can say unemployment is still relatively high, but of course, that's always the case after a recession. It takes time. So I think the combination of high valuation, Fed tapering, I think sooner than expected, I think could create a situation for markets where I think it's difficult to sustain the pace of growth that we have seen in the past few months.
What seems to be in I don't know whether it's a bubble or frothy, Luca. Is there something in the market that you're staying away from because you're expecting an imminent correction?
Well, look, we have been overweight equities for quite a long time. We decided to basically reduce our equity exposure because, yes, I think there is now still more on the downside, positioning, valuation, peak in economic momentum. But it's difficult to see anything but a kind of short and not even a significant correction because at the end of the day, the economic data continue to be solid. So I think we're going through a phase of consolidation, but we're not going through a phase of steep decline in asset prices just because, again, the fundamental story remain positive. And if you look at earnings, they're absolutely booming. So I think we are expecting a phase of consolidation, not a phase of steep declines for markets currently.
Well, Luca, you're also trimming your exposure to the cyclicals, and I wonder what that means for your view on Europe. Do you not see more catch-up opportunity for European equities from here?
Europe is a difficult one because Europe basically is the best region globally this year. And the best region at a time when we have seen a lot of things happening and most of them not positive. So you have seen basically a recession, ECB kind of not clear in a way in what they are doing. And still Europe has done very well. I think Europe, to be very optimistic on Europe, I think you need to see a real acceleration in growth. I suspect that you have to wait the second part of the year. And the reduction in cyclicals is mainly because of the performance that we have seen. We have seen commodity prices basically at 10-year high. We think that's probably has gone a little bit too far. And so we're not particularly bullish on Europe. But I have to say that I think there will be a good time to buy Europe, I think more in the second part of the year when the European economy has fully reopened.
How do you hedge against inflation, Luca? I was talking to the Siemens CEO, Roland Busch, a little bit earlier, and he said they're passing prices on to customers. This is something we heard from BMW today as well, and many of the car makers. Those prices aren't likely to come back down, right? So this inflation is, at least for some products, here to stay.
Well, I think we have to keep in mind, though, there is also a base effect. So I think, this rise in inflation partly is temporary, but I agree with you that for some corporation or company, it would be difficult to pass over this increase in price. For others, it's easier. So the best way to hedge against this is to be focused on companies with very strong pricing power. And I think when you look at assets in general, I'm afraid there are not many ways to hedge against a significant rise in inflation. We know from past experience about equities and bonds suffering this environment. You can, of course, look at gold, but gold has been struggling recently. So probably the best way to hedge against inflation now is to be kind of overweight commodities. But again, you look at the market moves and it's probably too late. So it's very difficult to hedge against a rise in inflation at the current time.
Thank you so much, Luca Paolini, their Chief Strategist at Pictet Asset Management. Now, coming up, it's Jobs Day, in case you hadn't noticed, in the U.S. We'll take a look at what to expect from the figures next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Francine Lacqua in London and Matt Miller in Berlin. Well, it's Jobs Day. Economists expect a sign today that fewer business restrictions are bringing more Americans back to work. The April jobs report is due out at 8:30 a.m. New York time. It's likely to show that the economy added about 1 million jobs last month. Joining us now is Michael McKee, Bloomberg International Economics and Policy Correspondent. Mike, it could be a strong number, but it is just one data point. And Jerome Powell has said he wants to see a quote-unquote string of jobs reports like March before he's confident in the recovery. Is March to April a string?
No, that's not going to be enough. And it's going to be interesting to see how the markets react to this. If we get a million jobs, they're expecting that. We're not going to move too much. There is one forecast for 2 million jobs. So if we got that, maybe they would move a little bit. The question is, how much is too much for Wall Street before the Fed? Fed's going to wait as long as possible. They're looking at the total number of jobs out there, and we're still 8 to 10 million below that, even if we get 1 million today. So the Fed's not looking to do anything right now. It's going to be several months. So I'm not sure how you trade this in the interim.
So, Mike, what else are you looking at in terms of, if you look at some of the surprises that we could get, does it give us an indication over an overheating economy, or what are you looking for?
Well, it's hard to say we're overheating at this point because this is such an unusual situation where we are reopening. I'd say we got 1 million jobs returned rather than created during the month. The thing that we're going to be looking at first is service industry jobs, because that's the industry that was hit the hardest. This chart is kind of interesting because it shows you the magnitude of what we're talking about here. You look all the way over on the right-hand side and you see that's a forecast for 1 million jobs. Doesn't look like much, does it? You look back at last year in March, April, and May, and we had such enormous swings that it's hard to get a feel for what actually matters. We know that the average hourly earnings, for example, are going to fall, even though people are coming back to work, because it's the low-paid workers coming back, and they're going to pull down the overall numbers. So it's going to take a couple months, not only of strong job growth, but to work last year out of the system so we get a clearer picture of what's going on.
Why are low-paid workers coming back? They're still getting these unemployment benefits. When I talk to hotel operators or restaurant operators around the U.S., they always tell us, Paul Sweeney and I talk to a lot of them on our radio program at 1 p.m., shameless plug, that they can't get anyone to come to work because they're getting too much from unemployment benefits. I always say, why don't you just raise their wages? At some point, that has to happen, right? Or unemployment benefits just run out.
Yeah, unemployment benefits, the extended unemployment benefits run out in September, so at some point people have a decision to make. The issue may be partly that people are getting more money in some states because some states are more generous. But it is also true that a lot of people's jobs aren't there anymore, especially if you were a bartender or a waitress or a bellman at a hotel that have closed. They don't have a place to go back to. So that's one issue. And what are they trained to do for other jobs? So it's a little bit harder to match up the labor supply with the openings that we have right now.
Well, yeah, to that point, Mike, we got NFIB data yesterday, a really good read on what small businesses are dealing with. 44% had job openings, 59% said they're trying to hire, almost a third of them raised compensation. There is a real labor shortage out there. Is that going to lead to more wage pressure? Is that being underestimated?
It's going to lead to more wage pressure, but it's probably going to be at the lower ends. These independent businesses may be offering more money, but they're not offering a lot more money. And the question then is, do we see that continue? In other words, if I raise my wages and Kaylee comes to work for me, then do I have to raise her wages again? Only if she sees that prices are going up and comes back to me and says, I can't live with this inflation, I need more money. And the Fed's betting that's the part that's not going to happen.
Yeah, unless she gets a better offer, right? So the problem, Mike, is that if you're worried, if the economy is picking up and you have other offers, then that's another way why you would put people's wages up. Michael McKee there. I'm really looking forward to that jobs number and all of the analysis that Michael will have. Neil Kashkari also. That is definitely the interview of the day. Now, coming up after the U.S. jobs report, Mike in conversation with Minneapolis Fed President Neil Kashkari. That's at 8:30 a.m. in New York, 1:30 p.m. in London. And then a little bit later, we'll get the Biden administration's view on the U.S. jobs report with Marty Walsh, U.S. Labor Secretary. That's at 9:30 a.m. in New York, 2:30 p.m. in London. And this is Bloomberg.
Tuesday, Bloomberg Technology brings you a special look into the recovery and renewal happening in Boston. Hear conversations from business and political leaders, including Moderna co-founder Noubar Afeyan, Bain Capital co-chairman Steve Paliuca, and Boston interim mayor Kim Janey. Catch the Bloomberg Technology Special on Boston's recovery, Tuesday at 5:30 p.m. on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Francine Lachlan, London, Matt Miller in Berlin, Kaylee Lyons in New York. Now, we're also joined by Tom Keene, co-anchor of Bloomberg Surveillance, to talk about jobs. I know, Tom, it's one of your favorite days of the quarters, but also the shakeup now at Credit Suisse, which continues over Archegos.
You know, the moving of the deck chairs at Credit Suisse. What's fascinating about this is this really is indicative, Francine, of the moving of the deck chairs regionally that you see. And Asia's already had this feel. Neil Olsey comes in to save the day. A couple years ago, people from Deutsche Bank went over to Credit Suisse, so the people from Credit Suisse didn't know where to go, so they went over to Deutsche Bank. And you get that's very fluid in Asia in terms of teams and trusted individuals moving around. Essentially, Credit Suisse takes the guy in Asia and helps them to solve the equity trading parts of what happened out of this family office disaster.
Right, and this is after Credit Suisse lost, everyone's aware of the story, but still a good reminder, lost $5.5 billion because of the collapse of Archegos Capital, and one of the reasons is that they were just not quick enough maybe to sell some of the equities. But Tom, I think it just goes to the underlying question for banking is how much risk do you take? And now they're, we're talking about a new overhaul, a new bank strategy, they have a new chairman, but is it just a bank that needs to be de-risked? And is that the path that it was over the last 5 years?
The theory is different than the greed. And the answer, Francine, witness what we saw this week about the amount of money they took in, given the amount of leverage and exposure the bank had, is it's amazing how much leverage you'll put on to bring in X amount of revenue generated in Zurich. I mean, the numbers still stun.
Yeah, they do, but then again, that depends on who's in charge, right? And at some point, somebody says, yes, we have risk appetite for this, or we don't. So that's the lens that we should be looking at is like, is this an overhaul of a bank that's needed, or is it more masking a more underlying question of actually, can we just afford that much risk for such a bank?
Yeah,
Tom, I'm looking forward to looking at your jobs analysis.
Yeah, we have Jobs Day. We're looking forward. It's just another boring Jobs Day. Snooze fest.
Yeah, the economy won't be overheating at all.
Yeah. I'm looking forward to, seriously, Mike McKee with Neil Kashkari after the jobs report will be interesting.
Yeah, Tom, thanks so much. Tom Keene there, co-anchor of Bloomberg Surveillance. Now, every Doge has its day, and this week it could be Saturday when the self-proclaimed Doge father, Elon Musk, hosts Saturday Night Live. Ahead of his appearance on the American comedy show, Dogecoin has staged a massive rally to become the fourth largest cryptocurrency. Well, joining us to make sense in all of this is Danny Berger. Danny, are we really at the point, first of all, I mean, this is probably my favorite hit of all time. Are we at the point where we can say that SNL is a market event?
We definitely are. Look, I don't know why we're talking about Jobs Day today. This is the market event that everybody is going to be looking towards and forward to. I mean, look, basically what's expected is Elon Musk is probably going to say some sort of joke about Dogecoin. There's going to be some skip. People are going to go in. They're going to buy it. But it really just encapsulates the world of meme investing. He's a great epitome of it. I mean, last month tweeting, calling himself the Doge father, promoting his SNL appearance. And look, it feels really silly to be talking about this. I mean, especially, after those great words from Tom Keene about a much more serious topic, but that's part of what's attractive here. The very fact it is a meme sort of thing is what gives it value, because it is fun to go in and to trade and to make money. And look, very serious market people have analysis about Dogecoin.
If $80 billion isn't serious, I don't know what we're doing here. I mean, that is 2 times Ford Motor Company's market cap. Thank you, Kaylee, for that little factoid. It's a massive amount of money, and kids all over the country are into it. what does it mean, though, for the rest of cryptos? Because I noticed sometimes CRYP goes, where you can pull up all the cryptocurrencies on Bloomberg. We don't have Dogecoin on there. Maybe it's Tom Keene's fault. But even as other cryptos come down, sometimes we see Doge rally up to 69 cents.
But, okay, well, Matt, I think part of what's behind this is Doge doesn't take itself seriously. Not that it's, a living being, but Doge investors don't, despite the fact there's a lot of money behind it. But that sort of idea isn't really great for Bitcoin advocates for Ethereum, because they want to be this serious store of value that has to do with limited supply.
Yeah, they hate it.
Those factors have nothing to do with why Dogecoin has been rallying. It doesn't have that supply thing. And so, that becomes a concern if you want to take other cryptos more seriously.
All right, Bloomberg's Danny Berger, thank you so much, guys. I am so excited for Saturday night. I almost am willing to put money down that Elon Musk is going to show up in a skit dressed as a Shiba Inu. Like, I feel like that is something that isn't out of the realm of possibility, Matt.
I can't wait to see how he is. I have faith that Elon Musk is going to be very funny and quite good on SNL. Now, I could be proved wrong. I've never seen him act before. But he could be absolutely hilarious, and I'm willing to stay in. Well, actually, I am willing to wake up early on a Sunday morning, because it's going to be 5:30 a.m. here to see Elon Musk star on SNL.
Right, except he's been so unpredictable. Maybe he shows up and wants to talk about the U.S. jobs report that we saw today. There you go, anew on SNL.
You can't rule anything out.
Overheating, of the economy and inflation forecast by Elon Musk. I'm also looking forward to it. I don't know whether Danny's
waking
feel like
up
it's overheating?
or staying
up late. Well, not for the moment, but at some point maybe it could.
Okay.
Elon Musk on Clubhouse talking about overheating with Putin. I don't know. We're making no sense, but this is kind of where a lot of these memes are going. Coming up next, Randy Krosner, University of Chicago professor and former Federal Reserve Bank governor. This is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Most forecasts suggest that at the end of this year, we will be better than we were projected to be before the pandemic.
We basically rebooted the global economy. We shut it down and turned it back on, and it's coming with a lot of messy frictions.
We should all recognize that the economy right now is experiencing a demand shock, the likes of which we haven't seen since World War II.
We need to not confuse a peaking in growth momentum with an end to very powerful growth.
The last thing in the world I really care about is that wages are going to explode. They are not.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It's Payrolls Friday from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Equity futures up 0.2% on the S&P, back through 4,200. Tom Keene, your estimate, 1 million.
Yeah, well, my estimate's 1 million. I won a pool once, John, like 4 years ago in the non-farm payrolls, and since then, I've never guessed it. But imagine what the standard error is this time around at 1 million. John, I love what David Blanchflower of Dartmouth College just said in our show opening. Wages will not explode. That is the question this morning.
That's a question for a couple of months' time. There's a compositional issue here where wages could actually fall, Tom, or at least stall. For the headline number, the range, wide. The low end 700K, the top end 2.1 million. Are we throwing darts this morning, Tom?
Well, I don't know if we're throwing darts, but we're going to have a linkage here of the markets into what we see. And I'm sorry, I see a very constructive tone in the markets before we get to this key economic data. We can take it any number of ways in our hours of surveillance, all the way up to where you speak with Secretary Walsh later this morning. The jobs data, I really don't know where to go beneath the headline data. We'll make it up at 8:30.
8:30, it's one piece of it, Tom. You get the jobs data, you can make up your analysis. Then, Lisa, we're going to be looking at the price action. How does this market respond to an upside surprise and a downside surprise?
That's what actually I was going to say. I love that Tom is saying, basically, if we'll just make something up and you should listen to it. Honestly, there is a question here about whether the risk is skewed to the downside with respect to the market response, that basically people are expecting an upside beat, that basically if there is not some sort of big beat, people will be disappointed. You will get yields falling, you will get stocks falling, and that, I think, is what I'm looking for, John.
What a morning we've got coming up for you. Here's the price action going into the print. Payrolls just around the corner. Equities up 8 on the S&P. We advanced 0.2% through 4,200 on the S&P 500. Yields have been lower through the week. They're up just a little bit this morning to 157.71 on 10s. Euro dollar, Lisa, 120.81. And in the commodity market, there is a wow number in copper. Copper through a record, through 10K, and taking out a decade-long record high.
And the interesting thing about the copper rally is that people think that it's going to continue, and potentially dramatically so if the dollar weakens, and if you continue to see the accelerating demand for renewable vehicles. We'll be talking about that throughout the show. Guess what? 8:30 a.m. It is the data point of the day. We get that non-farm payrolls report. The key question for me is compositional. We continue to talk about the K-shaped recovery. And we know that the Fed is watching this, so even if you get a blowout number, how much is this evenly distributed across the labor market? How much are services coming back online? And how much are those lower wage workers a precursor for a bigger wave across all of these sectors in terms of getting to full employment? And then at 11:30 a.m., President Biden is going to be talking about the payrolls report. Interesting to see how he skews it, because he will try to use it to push for his stimulus package, his infrastructure spending package. And yet some people may say, if it's too good, does that remove some of the oomph from your push to get something passed? And then at 12:30 p.m., Treasury Secretary Janet Yellen will be joining Jen Psaki for the press conference by the White House, talking about the job.
Hello, traders. Hope you're doing okay. Back to business. I'm going to place an order to buy Bitcoin. Yesterday we were selling, today we are buying. This is what it's all about to be a day trader. Okay, the price I'm looking to buy Bitcoin, 56,195. Okay, 56,195. Okay, let's see if I'll be able to execute this order. It's quite far away from the right now from the price, but hopefully we will get filled. Let's wait for about 10-15 minutes. Let's see where these will go to. Okay, if it will go up, I will have to cancel it. Also, I want to say that I'm going to place an order. I'll check the price, what my strategy tells me to buy euro. I'm looking to buy euro, and I'm looking to buy at 120.77. Okay, order placed to buy at 120.77. I'll place an order to buy euro. Okay, and what else? Nothing else. Okay, stay safe. If you want to follow all these two trades, please place your order to get filled. Don't delay, don't try to wait until it will move maybe lower or something like that. This strategy doesn't work like this. If you want to get the strategy, you need to go to companyeye.co.uk website, and you will get the strategy where you will find all your question answered. Why we buy at this specific price, what's happened next, how we place stop on profit, not stop loss. All this information will be answered. Okay, also will help you from the strategy. We don't advise you to trade through specific brokers. We're not a company that asks you trade through us or from the best brokers. All our sponsors you can see on our streamer, on the left side of the streamer, and we don't advise any brokers. We will help you to choose the right broker. Broker like a driver, you choose the company that will suit your needs, exactly what you need, how you want to trade, and this way you will find the right broker for you. Okay, I'll speak to you later, guys, and stay safe.
To equalize some of the playing field in addition to just the headline unemployment number?
Yeah, no, I think that's a very interesting and important point, because clearly the way Jay Powell has talked about the new framework of average inflation targeting, it's something that is about trying to reach an average inflation target over time rather than trying to be proactive, that if you see inflation coming that you react. And also the characterization of the labor market is that, you know, he's talked about how if we allow the economy to run a little bit hot, that can have additional benefits for many different groups that often don't benefit at the beginning of an upturn, but benefit more into it and further on in the upturn. And so they're going to really want to push the unemployment rate down further before acting. So I think that's very different than the regime that was there when I was there 10, 15 years ago.
Well, these are lessons learned from the previous cycle, Rand. And a question that I keep going back to, and I'd love your view on it. Why are the lessons learned from the previous cycle pertinent to this one? What we're experiencing now seems to be so unique.
Yeah, I think it is a boom like we've never really seen before, because you had something that was kind of a government-imposed collapse, which typically you don't see that, or at least not intentionally. Sometimes governments do make mistakes and you get collapses, but you know, shutting the economy down. And there's been an enormous buildup of savings and a lot of pent-up demand. So I think you're going to see really strong growth. And as you were mentioning, a lot of commodity prices have come up. You might see wage pressures also. And then the key will be, is this just sort of a quick boom, a short-term sort of transitory thing where prices are pushed up, or is this leading to more inflation down the line.
Randy, one of our themes on the show this week is really to look at the IS curve and to say what's the real economy doing versus the financial economy, where you are truly an expert. Are you more focused on the financial dynamics of rate, inflation, etc., or are you more focused on a study of America's real economy given this natural disaster?
Well, it's really the interaction between the two, because it'll be the bounce back in the real economy, and then how much pressure that's going to be putting on inflation expectations, how that will then lead to potentially higher borrowing costs, and then could that lead to on anchoring of expectations that if we do get a sustained boom, we do get the inflation moving up more rapidly and for a more extended period of time, could people say, hey, the Fed really has kind of given up on 2%. Maybe they're going to let it go a little bit more than that, even in the longer run. And so now I need compensation in longer term interest rates. The Fed certainly doesn't want to do that, but they could get into a difficult situation if the inflation is a little bit stronger and lasts for a little bit longer than they're hoping for.
Hey, Randy, we've got to leave it there. It's got to catch up on this Payrolls Friday. Randy Krosner there, University of Chicago Booth School Professor of Economics. Futures this morning positive. Your yield on a 10-year right now, 157, going into this print at 8:30 Eastern Time. This big conversation about a massive boom will dominate this morning. And Tom, a labor shortage and how governors across the United States of America are starting to respond to that. We saw it with Montana earlier this week. We saw it with South Carolina in the last 24 hours as well. These governors are pushing back against the increased additional entitlements for the unemployed, believing that that is disincentivizing a return to work. And we've not heard the end of this.
We have an Axios, I think, with a nice treatment yesterday on Uber and Lyft and on the incentives they need to do to get drivers back out there. John, it's very fluid, and I think, John, to say that we're going to go back and forth between market coverage and financial coverage and real economy coverage through to 8:30 is really quite germane. This is a really unique day.
Couldn't agree more. Lisa, do you think that's the risk around this number? That maybe for a lot of people, the demand was there, but they couldn't get the hiring done?
Yeah, trying to understand what this number actually means is the key problem. In other words, will the number just represent the cap of how hard it is to get people into the labor force, or will it really truly represent the dynamism of the economy with respect to how much companies want to hire?
Questions for the administration. Marty Walsh, the U.S. Labor Secretary, joining us after the payrolls report on Bloomberg The Open at around about 9:40.
Okay, guys, I need to cancel order to buy euro. It took some time, and right now looks like it changed its direction. So we'll probably, in about an hour or so, we'll probably sell short euro. For time being, please, if you decided to trade euro, cancel order to buy. Okay, and let's wait for other instructions. What exactly going to happen with euro? Stay safe.
This month, our survey also shows the jobless rate probably fell 0.2 of a percentage point to 5.8%. And a new report from the Fed warns that investors are gorging on risk, and that could lead to stretched valuations and vulnerabilities in the U.S. financial system. Fed Governor Lael Brainard also says the impact of the Archegos capital implosion shows that more hedge funds disclosure is needed. Meanwhile, there's more fallout at Credit Suisse in the wake of the Archegos collapse. Neil Hosey has been named head of equities for Europe, Middle East, and Africa. He's currently head of equities for Asia Pacific. Hosey replaces Ryan Nelson, who stepped down after Credit Suisse lost $5.5 billion over Archegos. And in China, exports rose more than expected last month because of growing global demand, and imports jumped on surging commodity prices. Exports grew 32% in dollar terms from a year ago. Imports were up some 43%. The parent of British Airways, IAG, reported mounting losses and says it's expecting only a gradual recovery in travel. The company also owns Spain's Iberia and Aer Lingus of Ireland. It will deploy only 25 of its 2019 capacity this quarter. IAG says a rebound to pre-pandemic levels will take until at least 2023. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.